Each other about some kind of bigger tie-up. So we're certainly watching Renault as they own a 35% stake in Nissan. AstraZeneca also in focus as well. We've seen some reporting elsewhere that talks about whether we might see a sales dip in China because of the arrest of one of their key staff in China.
I will show you how to get the best funding for your startup.
Let's talk about this market open. The opening trade is upon us. This is what you are looking at. I suspect it's going to be a fairly flat story. Here you go. The FTSE 100 delivering an exciting 0.03% to the upside. No, can't quite make up its mind. Oh, yeah, we are getting a bit more upside. But nevertheless, I feel like I'm dancing on the head of a pin here. The Stock 600 is delivering also something sensational this morning. The Spanish market is up by nearly 0.1%. Revolutionary. We will wait for the CAC 40. We will wait for the Italian market. We will wait for the DAX and the SMI to deliver their verdicts on what this session is going to look like. But I suspect, despite actually what is a fairly busy news agenda this morning, that equity markets may wait for the Fed a little bit later on. Critty.
In the meantime, we are seeing kind of a tale of two stories. You are seeing a little bit of a rebound in some of the French individual stocks that have been underperforming in the last couple of days. ASML at the top of that trade. You are seeing a couple of other movers there, but it really does feel like paring back some of the losses we've seen in the French market. Of course, we are still waiting for the full liquidity to show up, but just on my screen, we're seeing the likes of Sanofi, we're seeing the likes of ASML, even LVMH and Shell kind of driving the upside, which again have been the underperformers of the last couple of days. You're also seeing some of the automakers very much in focus. Mercedes-Benz is higher by about 0.9%. We should mention that there are talks happening at Volkswagen at the moment as well. That may be reflected in the Volkswagen shares as we get a little bit more liquidity, Anna.
Yeah, even if we don't seem to be getting very quickly to any kind of resolution of that, we do see autos and parts is the best performing sector this morning. And Volkswagen not doing too badly in the mix. They're up by, well, just 1%. Valeo, some of the other suppliers to the auto industry doing okay. Renault yet to open, though, I should say. And that's where we have that big exposure to the Japanese consolidation story. Energy not doing too badly as well. That sector also up by around 0.4%. In terms of the banking themes, you know, the banking sector overall is entirely flat. But there are really interesting things going on within this sector, aren't there? We're waiting to see, you know, how UniCredit performs. We're waiting to see how Commerzbank performs. I think UniCredit is just down 0.1%. How does Commerzbank perform on the back of this news that UniCredit has increased through derivatives, at least, its stake in that business? We're watching the French banking sector because we've got something we would expect from Moody's downgrading some of the outlooks for those, the performance of some of those banks or their expectations for those banks. So there's a lot to watch in the banking space.
Can I just say that gilt yields have gapped a little lower as well this morning on the back of the inflation.
After the big move yesterday to the upside.
Yeah, precisely. So, but we've not given all of it back. We've given some of it back. So I think the expectation post yesterday that we are going to see a more hawkish Bank of England sticks, despite the fact that actually inflation came in largely in line with expectations and didn't deliver that upside surprise this morning. So we're trading a little bit firmer on gilts after the move yesterday.
And yep, we see it. You see it on your screen just there. It's also worth pointing out that we're also getting, as Anna was pointing out, the banking sector, Commerzbank currently halted. I believe we're waiting for it to start trading. It says volatility interruption on our screen, but you are seeing some of the Italian names that trade lower. I'm seeing UniCredit, I'm seeing Banco BPM, and Monte Paschi, all of which are stakes in each other or potential stakes in each other, all trading lower this morning. It speaks to the idea of, do you actually want exposure to the Italian index as a whole in the face of some of this consolidation news? The same theme applies to the likes of Germany and France. Karen Ward, JP Morgan EMEA chief market strategist, joined the show yesterday. And here's what she had to say about that right mix of exposure. Take a listen.
yes, the US economy is going to do better under Trump, but that is in the price. That is why you're paying 22 times high earnings expectations for the US market and 14 times lower earnings expectations for the European market. We need to have a think about quite how overweight the US you want to be relative to Europe, because if I'm right on some of the policy catalysts coming through in China, in Europe, then maybe that's where the surprise is.
Joining us now is Lucy Baldwin, Global Head of Research over at Citigroup. Lucy, pleasure to have you on the program. We keep talking about this exposure story and whether or not, as we wait for maybe a cyclical uptick or an inflationary uptick, is Europe the right place to be? Your thoughts?
Yeah, absolutely. Well, look, we feel that the US market still does offer a number of attractions. So we would certainly suggest to investors to stay invested, right? There's obviously a lot of policy surprises potentially to come next year in the United States. But what we would say to people is to barbell it and to also have some exposure to Europe, because we do feel that Europe is incredibly unloved, right? It's the big theme at the moment, really, is how much more unloved can Europe possibly get? It's at a 40% discount to the US. It's pretty extreme by any historical standards, that gap between the two markets. And we do think there's a number of catalysts to the points that Karen was raising there. We think potential ceasefire could be an upside catalyst. We think there will be fiscal stimulus coming through from China. And I think that could still be a meaningful upside when it comes through, if that can start to see some short-term impacts. There's also clearly a series of other potential catalysts around maybe trade being more of a negotiating point with Trump 2.0 rather than just a blanket set of tariffs. So I think there's a few things that could give us hope that Europe is going to see, if not double-digit upside to the market next year, then at least very high single-digit upside, because we do think you are going to see some earnings growth and there is some scope for a re-rating.
Did we just find a Europe bull in the wilds?
Maybe she won't go that far.
Endangered species, for sure.
It's certainly a rare one, for sure. But you pointed to a lot of catalysts that are outside of Europe, and you mentioned the fiscal stimulus read-through from China. Is there a prospect of fiscal stimulus from European governments? We've seen that in Italy. Do you see that in other parts of Europe?
Yeah, I think the big hope there is obviously Germany. People expecting to see, around German elections, some sort of hope of a mini Trump type situation there, where you can have a bit of a regulatory reset, ripping up some red tape, and you can get some fiscal stimulus coming through. We all know that the German consumer could, in theory, go out and spend. It's obviously one of the countries that has got that fiscal capacity. So there is that big hope that Germany might be that catalyst that Europe very much needs.
I love it. In theory, the Germans might go and spend.
I was a consumer analyst guy for many, many years, and it was something we were expecting to see for a long time. So there is always a bit of caution there.
It's always potentially out there, German consumers, if they can actually find time to go shopping. The equity market in the United States, some would argue, is very expensive. If it were to catch a cold, would Europe be a place to hide out, or would Europe suffer more than the United States if the US goes down?
I think it's going to depend on a lot of other factors. So just to sort of take you through how we think about the US, broadly we're expecting to see double-digit earnings growth next year coming through from the US, actually slightly more than we've even seen this year.
Yep.
I think it's going to be hard to hold that multiple because, to your point, versus any sort of historical metrics, we're at pretty much all-time highs, right? So we probably get a bit of a derating, but with sort of up towards maybe even mid-teens earnings growth next year, you can still have some great momentum coming out of that market. You can see broadening in that market beyond the big cap names, because we all know the concentration challenges and risks. And I think thematically, the different policies that will come through will give room to run for different parts of the US equity market that perhaps haven't seen that in the last couple of years, in these last two big bull markets. I think when you sort of put that alongside what we see in Europe, I think really the interesting thing with Europe is there are some really great quality names. We relatively recently upgraded the luxury sector, for example, going back to the China story. So I think if the US equity market catches a cold, it's most likely to be probably on the back of tariffs, right? If you think about the four main streams of policies that are going to come through, taxes, i.e. fiscal, trade, immigration, and the sort of regulatory reset. I think the area that's going to be the big risk, where you could see sort of negative demand and supply shocks, is the trade war. And obviously that is, at the moment, something that people, I think, subscribe less than a sort of 30% chance to seeing very broad tariffs on everything and big retaliation. I think if that were to happen, that's going to be bad news for all equity markets. But for sure, I think Europe would be relatively better insulated than the US, is how I would think about it. So I would try and have a fairly diversified portfolio of equities with some of those really high quality growth, some value opportunities.
Right.
We've actually, interestingly, at an asset allocation level, suggested to people that Japan is the market to be the most cautious on and to be underweight as the hedge.
Thinking about 2025. Sorry, I was distracted, Lucy, because I was thinking about this statement that you made in your research, in your notes, which I thought was really interesting. You say 2025 is all about sequencing of Trump trades.
Yes.
So tell us more about why the sequencing matters.
Well, I think the sequencing is going to matter because potentially a lot of the things that people are very worried about either might not happen because they've got to go through Congress or they're going to take a very long time. So the big debate is whether some of the good stuff comes early or whether it comes late. And again, sort of very broad brush, if you think about those 4 policy pillars, I think people are obviously very excited about the regulatory reset and about potentially the fiscal support that might come through. Again, we would suggest that's not going to be of huge orders of magnitude. We and most economists haven't meaningfully changed their forecasts for growth here on the back of it. But if those are the 2 positives, the 2 sort of negatives that everyone's worrying about in terms of weighing on growth and risks to inflation are obviously the other 2, i.e. the trade war and the tariffs and the immigration story. And so I think when you sort of pull all of that together, what you're really going to see there is the sort of net effect of those things playing out is what you've got to watch. And we think that broadly, yes, that will be a little bit more inflation, but it's probably also a little bit more growth.
Yes, okay. And do you worry at all that the market has been quick to price in those positives already, regardless of the timing of the actual announcements in 2025, and has left the negatives to the side because they've said there's too much uncertainty around those?
Yeah, and I think to your point, right, on the sequencing, I think some of those things are going to require going through, getting Congress's support. So some of the major tax type reforms would come much later. So your risk is that some of the negative stuff happens earlier, right, and that you end up with things via executive order like tariffs happening earlier. So I think that's why people feel the volatility going into next year could be very much higher. But I think there is a reasonable amount, clearly, of optimism priced into the US market, which is why the tariff case is such a sort of curveball wild card. When we look at the US, it is actually our biggest wildcard market overall, which is why it's hard to say definitively, oh, it's all there, it's all in the price. So just to give you a bit of a flavour, in our outlook that we've just published, our US economist has actually stuck to a much more cautious stance on the US. He thinks you could get 125 basis points of cuts in next year because he still feels the labour market is going to loosen substantially at some point. Now, that is a very out of consensus call.
Dot's not likely to show that today, at least.
No,
we'll see.
No.
We'll see a little bit later on. Let's just talk about the breadth of the market. You referenced this a little bit earlier on. The breadth of the market is getting narrower, not broader. And you've also got portfolio managers. I looked at the fund manager survey yesterday. Basically, as long as they can be. I think they're pretty much out of money. Retail is as long as it's ever been. I think it's pretty much out of money. There may be a little bit left in the money market accounts. What is the impetus?
Yeah, who's the incremental?
Where does it come from?
Yeah, look, I think, essentially, to your point, right, you have to have that earnings growth coming through. So ultimately, the call on the broadening has to be that the small mid-cap components of the market start to see upside surprises to growth, right? And you start to see that coming through. And a lot of that goes back to the AI boom and whether you actually see things like, beyond the infrastructure names, beyond big tech, you start to see the rest of that ecosystem where the $1 trillion of capex is getting spent, you start to see the returns coming through and the growth coming through in some of those names. We do think, though, that there are parts of the market, going back to the policy implications of next year and where we're going to go, we do think areas of the market like financials have got further room to run. We'd expect to see increases in capital markets activity, M&A, etc. Deregulation. That, I think, is going to be a big positive for those parts of the market where we'd still see upside. And I think parts of the energy complex as well, where you'll see that deregulation story panning out, as well as the consumer. Never bet against the US consumer, Guy. That's always
the German consumer's fair game, but the US consumer, not so much.
Absolutely.
Nice to see you.
Great to see
Christmas.
you too. Merry
Thank you very
Christmas.
much. Lucy Baldwin, Global Head of Research, joining us from Citi. Core 6 looks like this. Let's take a look at some of those luxury names and see how they are performing today. a little on the downside, but not by much. Ferrari and LVMH both a bit soft. Tech's having a slightly better day. I'm going to include Schneider in there. Nestle continues to push lower. Novo down by 0.9%. Single stock stories. Let's get more details on what is happening in banking, etc., etc. Joe Easton's here with the details.
So we are seeing a big gain first in the auto space for Renault over in Paris. It is the best performing stock on the entire Stocks Europe 600 today, given that massive jump we saw overnight in the share price for Nissan in Japan following news of that tie-up with Honda. Lots of moving parts on that one. So the stock gaining, remember, a 36% stake, really beneficial for Renault today. Then in terms of the banks, another sector that's got a lot to keep track of. There's a move higher in Commerzbank. News breaking moments ago, UniCredit ranking up its exposure to the German lender, about 28%, a lot of that through derivatives. And then the other bit, just to confuse us even more, Banco BPM is also involved in this because, remember, there was a bid for BPM from UniCredit, and BPM today out saying they need a bit of protection potentially from the government on that one. Then we'll check in on Astra. That one was declining as well as expected at the open. We're down 1.1% for AstraZeneca. News from the FT of potentially a decline in sales in China that hit overnight, and we're seeing Astra reacting to that one. Then we do have a bit of a write-down over in the paper and packaging spaces, doing all the glamorous sectors today. That was Stora Enso over in Helsinki, saying they're going to write down a number of items on their balance sheet on that one. I have to take my word for it, that one is lower today. And then in terms of ratings, Canal Plus, the French TV company, of course, is listed in London. There's Stora Enso. That was in the corner of my eye there, but it is down as expected. But in the French TV space, Canal Plus, where else would it be listed? But it's listed in London, just to add to the confusion on that one. But it has got its first new buy rating since we got the IPO from that yesterday, actually 2 days ago. So that one is rising. We got a buy for that company. That one is gaining, Canal Plus in London this morning.
Okay, see, we do listings, do new money in the market. Joe, thank you very much. Joe Easton from our equities team with a briefing on all of those stocks that are on the move, from banks to cars to media to finished paper, all in the mix. Coming up on the programme, we will dive deeper into that banking story of this morning. Commerzbank shares rising as UniCredit hikes its stake to 28%. That's next. That being done through derivatives, asking if they can fully increase the stake above that 10% level, trying to get that permission. We'll dive deeper into the details. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Welcome back to the program. Now, UniCredit has increased its holding in Commerzbank to about 28%. The move ratcheting up CEO Andrea Orcel's pursuit of the German lender. Let's get more with Bloomberg's Arno Schützer, who's in Frankfurt for us, covering this story. Arno, tell us more about what UniCredit, what Andrea Orcel are hoping to achieve here. Once again, we are told today that this is solely an investment, but we all know that there are other intentions behind it.
Yeah, well, basically, Orcel is telling the world today that he is still serious about this his Commerzbank potential deal. When he bought or when he made an offer for Italian bank Banco BPM a couple of days ago, he said that the probability of actually doing Commerzbank as well has become lower, although not zero. And with this deal today, he definitely says, okay, I still mean it. I still want to go for Commerzbank.
What's the pushback, though, Arno? And is money part of that, given that not only is Commerzbank one of the assets that he's hunting for, he has plenty, and you mentioned Banco BPM. Is there enough money for this? Is there pushback on this deal outside of the government as well?
Yeah, well, as you say, sort of the government has opposed this. There's an upcoming election in Germany, so government is likely to change. Although the Conservative Party, which is ahead in the polls, is likely to win that, and they have said that they are also against a deal. So probably the political stance is not going to change much. There's been a lot of pushback from the labor side. They've staged demonstrations and done a lot of internal meetings and everything. Yeah, so there is pushback. There's some pushback from clients as well, but on the other hand, sort of Germany is generally regarded as an overbanked country, so there's plenty of rivals who are ready to step in, and some of them, including Deutsche Bank, have said that they're already winning business.
Arno, we're going to leave it there. Great stuff. Thank you very much indeed. Arno Schützer joining us on what is happening in the European bank consolidation story, which feels it has many twists and turns still to come. Consolidation is a theme this morning. Shares in Nissan surging the most in 5 months, or in 5 decades. Bit of a longer time frame. This, as Bloomberg learns that the Japanese automaker is in talks to merge potentially with Honda. That's one of the options. Bloomberg's Craig Trudell joins us now. Why is this necessary?
I mean, I think you have to go back to when Carlos Ghosn was pushed out at Nissan, and you had an attempt on the part of the Japanese government and METI to really sort of get their arms around this and find a sort of way forward for Nissan. It was clear that there was some real discomfort within the company with working with Renault and potentially a merger with Renault. Yep. And there was a lot of sort of nationalistic undertones to opposition to that. There was a natural sort of suitor within Japan in Honda. The problem was always that was a company that had a sort of fierce independent streak on its own. I think this was a matter of conflicting priorities on the government of wanting to actually do less of these cross shareholdings within Japan. I think eventually it got to the point where Nissan was so struggling and so underperforming that this is a matter of more necessity at this point, that they really need someone to step in and help stop the bleeding.
So these are two businesses that had already said that they were cooperating with each other, working with each other on EVs, which is a large part of what car companies are working on these days.
Yep.
And now there's talk of broadening this cooperation and doing some sort of deal then. Does this tell us anything about the template for how you compete with the likes of Tesla, with the Chinese auto manufacturers? Consolidation has to be part of the story.
Maybe. I think it remains to be seen just how effective that's going to be in sort of, helping right what's wrong with some of these legacy companies, because we've seen here in Europe, in Stellantis, a company that I wouldn't say necessarily is in the wilderness from an EV perspective, but from a broader state of the company is not performing well whatsoever. I do think that in the end you ultimately need to be much more competitive on costs and on product appeal to keep up with Tesla and BYD, and we've not really seen a sort of quote unquote legacy car maker step up and really answer emphatically against these challenges. It is really difficult, and I do think that these companies also are still making quite a bit of money.
Isn't that
not
company
making
Toyota? This deal just flags to me just how well Toyota is doing.
Yeah.
Toyota's delivered in so many ways as we work our way through this transition. But the key one is that they figured out that actually hybrids are an interim step maybe to that EV. Everybody else has kind of tried to leapfrog to EVs. They haven't done that.
Yeah.
And they're producing cars now that people want to buy. Isn't that something maybe that others should mimic? Maybe it's less to do with kind of the other aspects of this story, but more actually just deliver a product that is usable by consumers. If you don't have the infrastructure, you need a hybrid.
I think that's a totally valid question, and I think the answer to that has maybe evolved just in the last couple of years, where I think a lot of the sort of consensus even just a couple of years ago was Toyota's missing the boat here too. They're sort of deliberately electing not to compete in the way of the future, and I think as an industry we're really sort of waking up to this reality of the buyer, the consumer, is not where the analysts or where Elon Musk thought they were even just a few years ago. It absolutely is the case that Toyota made the right bet, and I do think that is something that Honda brings to the table that could be really helpful to Nissan. Nissan was not investing in hybrids. They did try to make the sort of leap to battery electric vehicles. That was not at all effective or successful. The Leaf was a total disappointment, and they've not been able to follow that up with any successful EVs. And so, Honda has some real strength with respect to hybrids that are more akin to the Prius. And I do think that that's something that could really help them, particularly in the U.S., where Nissan used to be, making quite a bit of money.
Craig, thank you very much. Thanks for the update. Craig Trudell, Bloomberg's Global Autos editor. Plenty of M&A to talk about then. M&A Wednesday, we'll work on a more alliterative title for that. We're looking at the banking sector, looking at the car sector, and all of that merger talk within both of those. We will move on to talk about the luxury sector, though, in a moment. Coming up, after a lackluster year, European luxury stocks have been getting a boost from China. Is the floor in for some of the names in the luxury sector? We'll get some analysis of where the sector goes from here. Aurélie Husson-Dumitier, Luxury and Sporting Goods Equity Research Director at HSBC, joins us to talk us through the thinking on luxury stocks. This is Bloomberg.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is... Because it feels like this next one you're doing is sort of back in your sweet spot.
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together. And that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
You're spoken, sorry.
My voice and my conversation, my poetry, you know.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is the opening trade, 30 minutes into today's session, and the picture looks fairly flat, really, entirely flat on the Stoxx 600. Lots of interesting stories from cars to banks under the surface, but at surface level, not much on the move. The FTSE 100 up 0.2%. Elsewhere, we see more modest gains. Let's pivot our attention to one sector that has been under pressure this year. Chinese commitments to growth since September may have lacked the detail that investors are looking for, but could they have put a floor under European luxury stocks? Here to discuss the sector, Aurélie Husson-de-Moutier, who's Luxury and Sporting Goods Equity Research Director at HSBC. Aurélie, nice of you to join us today on the programme. So do you think then that some of the commentary we've had out of China since September, has that succeeded in putting something of a floor under the luxury goods sector?
Well, thank you very much, Anna, for inviting me again. Yes, indeed. We have turned positive on the luxury sector at HSBC at the beginning of December on the fact that we believe that Q3 sales growth was actually the trough, and that in Q4, even though the growth will not be extremely high, it shall be better than Q3. This is for mainly two reasons. First, as you mentioned, China stopped worsening, but also we have had some evidence that since the election, the American consumer trends is much better. So this gives us an idea of we should start seeing luxury growth trends to improve as of Q4.
Yes, so talk to me about the role that both of those markets are playing, Aurélie. I mean, it'll vary by business, I imagine, but which are you watching most carefully to get the next upside for the luxury sector? Is it going to come from China, or is it going to come from the US?
It's actually going to come from the US. The US has, during COVID years, the US consumer has become the most important luxury consumer in the world. And it's true that with the plans that some of the luxury brands have to expand with store openings in the US, plus the fact that we expect some volume growth, especially in that market, we expect 4% growth for the 2025 for the luxury sector, and we expect 7% coming from the US and from the US consumer.
Aurélie, it's Creedy in London. How much pricing power do these luxury brands have, specifically when it comes to the United States, given that so much of the earnings growth and the outperformance has come in the wealthiest parts of the American economy?
Well, yes, it's a fact that pricing has become an issue because during the COVID years, most of these brands have passed on massive price increases, roughly 54% between 2019 and the end of 2023. So pricing has become an issue for the aspirational consumers, and we expect in 2025 that the pricing component in the algorithm of growth will be limited. Around 1% to 2% maximum in the 4% growth that we expect.
But is the pricing power perhaps larger in other parts of the world, China, the Middle East, for example? Is there a little bit more room to maneuver there?
When it comes to pricing power, I think it's more or less the same in all the regions. What has been lacking probably for some of these brands in the sector is innovation. So they have sold the same product with a 54% increase versus 2019. So I would say that the pricing power is more or less in all regions. Clearly, the brands that are addressing the wealthiest part of the luxury consumers, such as Hermès, has performed better than some others. But in general, I would say that the pricing power is more or less the same in all regions.
Aurélie, good morning. It's Guy. What is the relationship between European luxury stocks and the US stock market? If the US stock market were to go down quite significantly, what would be the read across? What's the beta on European luxury and, say, the NASDAQ?
That is true that you have part of the consumption of luxury that is pretty much linked to the US stock market, but not only. Bitcoins can also be kind of an indicator. And generally, but when it comes to the luxury sector, I would say it's more the sense of confidence in the future that leads to sales reacceleration. And as consumers feel a bit safer about the future, they tend to spend more.
And what is the discount when it comes to Europe? These are mainly European companies. How big a discount do you think is applied simply because they are European?
Discount in terms of valuation, you mean?
Yeah, they exist in the CAC 40. And what we've tended to see on days when you've had French political turbulence or European political turbulence, you've seen these stocks going down. These are companies that have global footprints, yet they do seem to be impacted by European factors, and I'm wondering kind of how you think about that relationship going forward. We're going into another year potentially of political turbulence, of an uncertain future for Europe. Do I need to look through that when I think about these luxury names?
Yes, I think it's important to look, for the growth in the midterm for the luxury sector, and clearly current valuation shows that market is pricing the fact that in 2026 probably growth will return to historical average. When it comes to general macro factors affecting the share prices, I would say that what is coming from China has probably more of an impact than anything going into France, for example, or in Europe in general. It's definitely news coming from China and also now news coming from the US that are affecting the luxury share price performance much more.
Aurélie, would you describe what's going on in China as cyclical, or is there a structural element to it as well? Is there a rethink of interest, desire to own luxury goods coming from Europe, either due to just evolving tastes or politics, for example, or is that to overstate things? Is it all entirely cyclical?
Well, that's an excellent question, and it's probably the question that we receive the most from investors. At HSBC, we believe that the growth, that what is coming now from China is much more cyclical than structural, and that the growth in China will resume in the years to come. Probably not as soon as 2025, because we do not expect much growth coming from China and from the Chinese consumer, but we are very confident that the luxury sector will regain some traction with the Chinese probably as soon as 2026.
Aurélie, great stuff. Thank you very much indeed for your time this morning. We really, really appreciate it. We'll look forward to seeing you again next year. Aurélie Husson de Moutier, Luxury and Sporting Goods Equity Research Director, joining us from HSBC. Coming up, we need to turn our attention back to what is happening in the UK. UK inflation hits an 8-month high. What could that mean for the Bank of England's rate decision, which comes tomorrow? We will discuss that next. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the opening trade. 41 minutes into Wednesday's session, and European equity markets looking, well, flat to positive as we wait for the Fed's rate decision later on today. In terms of things we have learned already this morning, UK inflation is one of those. It has risen to an 8-month high in the month of November, drifting further above the Bank of England's 2% target. The data supporting expectations that the central bank will hold rates at its final meeting of the year. Dan Hansen from Bloomberg Economics joins us now. Well, what a trip we've been on, a journey, I suppose, in the last 48 hours then, Dan, because yesterday you were here, we were talking about this really strong wage data, gilt yields were up, the pound was up, and then today we unwind at least some of that market move and some of that expectation about next year.
Yeah, I mean, I think this morning is just a bit of relief that we didn't get another massive upside surprise. So when we were putting together the forecast for this CPI release, I felt that there was a much bigger chance of an upside surprise than a downside surprise when you sort of put all the pieces together. We didn't get that. But obviously this morning, I think there's just this relief, effectively. I mean, there was a massive move yesterday on the wage data. And it's really interesting, because I think if you look at how the bank has been behaving, it has been downplaying data surprises over the past 6 months. It's on this track, this gradual cutting track. And we're not in 2023, where they were buffeted by these huge shocks. And remember, they did this late cycle 50 basis point hike which surprised us all, and then paused, surprised with a pause. So I think, that move seemed enormous to me, and I think this morning they're just sort of, markets are just pretty relieved, to be honest with you.
On October the 3rd, the Governor of the Bank of England said that the bank could become more aggressive, quote, on interest rate cuts.
Yes.
How does that stand up to the test of time?
Not very well, does it?
No.
I mean, he clearly wasn't aware of the contents of Rachel Reeves' budget.
That's fair.
And that has clearly been the difference between him moving towards this sort of more aggressive stance and stepping back from that, which is he did at the Treasury Select Committee. He said, if you asked me 6 weeks ago, I was on the sort of side of the doves. You ask me now, I'm sort of a little bit more hawkish, a little bit more worried about structurally higher inflation in the UK.
Can we blame Rachel Reeves entirely for that? Or is it a misread of the situation more broadly?
I think if you look at how much the outlook has changed because of the budget, it's pretty material. And I think if you're looking at their forecast between August and November, all of the news was related to the budget. So I think it has had a pretty material impact on his thinking,
You talk about the makeup, though, of this inflation. I think it's pretty staggering that it's coming from goods as opposed to services. That's a stark difference from other countries that are seeing inflation now.
Yeah, so this morning's data was all about this re-acceleration in goods inflation, or core goods inflation, which strips out some of the volatile stuff. And what's interesting about that is that has been the driver, at least this year, of the disinflation. So we started at 4, we got all the way down to 1.7 at one point. That is now unwinding as the level of prices sort of moves back to more normal and price growth rates move to more normal levels. So there's this interesting balance as we move next year and beyond in the medium term between services inflation, which is we talk about all the time, and that's the thing that the Bank of England's obsessed about, and goods inflation, and where services inflation needs to head. Because for me, I think services inflation probably needs to head quite a lot lower than a sort of long-term average analysis might tell you, not least because you're not having this big disinflationary impulse from China, which we had over the 2000s, and then goods prices fell dramatically. So I think there's this interesting question about balance and how far services inflation needs to be pushed. So we're at 5 at the moment. We probably need to get to at least 3, maybe even a bit below that. So we've got quite a way to go if you're going to get 2% inflation sustainably.
And so what does that mean for next year and the number of cuts we price in, if there's still that move downwards that we need to see in services inflation then, Dan?
Yeah, so the market, as we spoke about yesterday and this morning, the market's got, I think, 60 basis points now, so sort of torn between 2 and 3. I think they'll get to 4, maybe a touch below 4. So I think 75 or 100 is more likely. Our base case is 100. Okay. We've put out a note recently saying we don't think there's much space to go below that.
So not too held back by the stickiness of that services inflation then?
I think one of the things about UK, particularly services inflation, is that come April you get a re-indexation of all the price, or a lot of the prices in the basket. And what you get, obviously that's related to inflation last year. So if inflation last year was lower than the year before that, you get this move lower. So I think we'll go from a sort of 4.5, 5 world for services inflation to a 4% world. That's still not obviously 3%. I was just talking with Critty, but I think that gives them a bit of space to take the foot off the brake and also think about the labour market.
The budget seems to have been positive for inflation and negative for growth. How does the Bank of England deal with the growth bit? If we end up in a stagflationary environment, does the bank have to lean on the inflationary side of the equation and not worry too much about the growth side of the equation?
So, direct answer to that question, yes. But in terms of the budget, I think there's been a lot of noise about the private sector. Yeah. What's been missed is that there's an enormous...
Huge pay rises coming through, etc.
Exactly. There's an enormous amount on the government side that's going to come through in 2025. So the net impact of the budget was to loosen fiscal policy. So government will support growth, but what we're hearing sort of, in the media and the like, we're just getting a lot of news about the private sector, which obviously with this enormous rise in employer national insurance, it is clearly negative for the private sector. In terms of your point about growth versus inflation, yes, they will focus on the inflation side, but I think the challenge the UK has got is around supply, about productivity growth, about labour supply, and the fact that basically the economy can't grow that fast without stoking inflationary pressure. So we shouldn't really be too surprised that we have these what seem like very anemic growth rates, because that's all the economy can tolerate. How far? Yeah, exactly. Without stoking inflation. So I think for me, the experience of the past 2 years is that the bank will focus very much on the inflation side, and the economy will just sort of be a sort of bystander in many ways as it sort of tries to bring inflation back to 2%.
All right, Dan Hansen, Bloomberg Economics, walking us through the UK story. We thank you so much. Let's go to the other side of the Atlantic, where Bank of America CEO Brian Moynihan is warning that the American economy may not need too much stimulus. Moynihan speaking with Bloomberg about where he's seeing signs of strength, including in the consumer sector. Take a listen.
If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted, and a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a balance, anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm and discussion, but everything's still out there until the policy gets enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. And so we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for a 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on it.
Bank of America CEO Brian Moynihan, they're ending his comments talking about that regulation. He also spoke about the idea that Donald Trump is going to bring in this era of deregulation, specifically around these capital requirement rules. And I think this is really important, because this is something that the likes of Elizabeth Warren, for example, has been pushing very aggressively in Congress. It's also one that's affecting the debate here in Europe, where if you start to see a kind of decrease in those requirements in the U.S., how do European banks actually compete? The EU, for example, and the European kind of regulators have said they're willing to bring it down to compete with it. Switzerland has taken a very different approach, saying, actually, we're going to be even more stringent to be more protectionist and more protective of our economy.
We've seen all the CEOs from the big banks in America on Capitol Hill arguing for lower regulation, not full implementation of some of these Basel III rules, haven't we? And with Trump coming in, I just wonder if it's already in the price. We see bank stocks was part of that Trump trade initially, wasn't it? An expectation of lower regulation.
The bit that may not be in the price is the fact that the banks could go out and lend more. Into the economy, and you could therefore see more liquidity, money being created effectively by the banks as they lend more money out into the economy, and that increases the overall liquidity pool. How do asset prices react to that could be quite interesting.
But there's hesitation in that, because it hasn't; those rules haven't triggered yet in the United States or in Europe. This is all talk at the moment. So if you're a bank, you just kind of hold on to that firepower in the case of you may need to hold on to it for these capital requirement ratios.
Maybe not. The mood music seems to be moving in their favour.
Yeah.
The music's getting brighter, for the banks, it seems.
But this is where it puts Switzerland really into context because it affects UBS, and UBS's share price is traded off of these headlines coming out of that. A lot of nerdiness around the regulation story, a lot of focus on Washington, and specifically today as well, we get the FOMC rate decision at 7 p.m. UK time. 30 minutes later, Chairman Jay Powell is going to be speaking at his press conference as well. And then I feel like this isn't the highlight of the day, but Micron earnings after the bell, and in the context of the major moves we've seen in Broadcom stock, this will be crucial as well, Guy.
Let's talk about the main event. It may be Micron a little bit later on. If you get a move like Broadcom we saw the other day, could certainly be. Let's talk about what we get from the Fed today. The expectation is that we get a 25 bips. The forward-looking story is where the interest is going to lie. Are we going to go from 4 to 3 cuts next year, or are we going to go from 4 to 2 cuts next year, Valerie Teitel?
Yeah, that's a big question in terms of the dot plot. Just how many cuts will the Federal Reserve members pencil in? And could we even see a Federal Reserve member pencil in no cuts for next year? I think a lot of Powell's posturing in the press conference, just how cautious he seems, how often he used the words, let's move gradually on the pace of rate cuts, could get the market thinking that we could be witnessing the last cut of the cycle today. There could be a chance that this is a Fed going on pause in January for an extended amount of time. And I think his posturing and the way that he spins this message in the press conference will be closely watched. That we know that the market loves to jump ahead to the next conclusion. And I think the next conclusion for the market is just when the rate cutting cycle is going to come to an end.
Yes, we had a really interesting conversation with Chris Wiley earlier on about the market's mentality. It's still we're still in a mentality of rates coming down, and the point at which that switches and the market becomes really afraid that the next move is higher, then things really do change. With that in mind, will we get any clues today as to how the Fed is going to think about big policy changes that will come with the new president in the United States, whether that's around immigration, whether that's around tariffs? Of course, they don't want to factor anything, fully, deliberately, numerically into forecasts, I suppose, because they don't know what is being planned, but some sense of thinking about that. They'll be asked, won't they?
That would definitely be asked. Maybe we'll get hints of it in their projections. We do get their GDP projections for next year. Maybe a bit of that revising higher. He'll be asked on why, what drove that revision higher, and he could point to things such as you mentioned, the new economic policy under Trump. It'd be very interesting to see how he answers these questions. And he was asked very often, how does a Trump regime change the outlook for rates next year? And a lot of his discussion has been, look, even if we do get good things for economic growth, like deregulation, like the extension of these tax cuts, it could be until 2026 that we have to wait to see the boost to growth. So he could maybe push out any expectations that it affects their immediate thinking, maybe come to the January decision, and use words like we want to have a gradual approach, we want to tread carefully. They'll make the market assume that a Fed pause in January is on the cards.
The timing is really interesting because didn't we have this movie play out in March of 2019? We had extremely tight labor market, very low unemployment. The economy was doing great, and he installed an insurance rate cut instead as just that, insurance. And I'm wondering how much pushback he got then, where he may not do it again this time.
Yeah, maybe we'll see that reflected in the dot plot, just how many members maybe don't see any rate cuts next year. Maybe some of them on the FOMC are more concerned about a resurgence in inflation, perhaps, as you mentioned, the tightening of the labor market. If there is a big deportation of immigrants, perhaps that those metrics could mean that the Fed could be on an extended pause next year. I really think that dot plot is going to be very interesting. And remember, it drops at 7 alongside the rate decision. So we have a whole 30 minutes of the market on bated breath trying to digest the dot plot and what that means. And the 2025 dots, not even just where the median is, but how wide the dispersion could be, could maybe reflect some division at the FOMC.
Really interesting. Lots to watch then in the dots, the forecast and the wording, the way the Powell responds to all the questions around the new presidency. Valerie, thank you so much for the analysis. Bloomberg's Valerie Teitel with a look ahead to the Fed. That is really the big market event of the day. We will be speaking with the U.S. Secretary of State, Anthony Blinken, today about developments in the Middle East, as well as in Ukraine and the foreign policy transition. In fact, this is coming up tomorrow under a second Trump administration. You can catch that, yes, tomorrow, 1:15 p.m. UK time. So stay with us for that. That is it for the opening trade. The Pulse is up next. They'll continue to count you down to the Fed. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Traders await the Fed's final decision of the year, pricing in a quarter-point cut. The focus, of course, will be on the rate path ahead. Now, Nissan shares soar as it explores a mega merger with Honda, with iPhone maker Foxconn also on the hunt for a stake. Plus, UniCredit raises its stake in Commerzbank as chief executive Andrea Orcel keeps up his pursuit of the German lender. Now, also this hour, exclusive conversation with the AXA chief executive, Thomas Buberl. We'll talk M&A, increased volatility, and, of course, some of the top risks facing companies, including geopolitics. Now, let's take a look at the European markets map. But the focus, the market event of the day and the week, of course, is the Fed. Now, that's translating into a pretty shy or timid a lot of European stocks. You can see the FTSE getting some 0.3%. There's a couple of repricing, also on BOE expectations, so we'll get to that in a second. The DAX 0.1% higher, but it's very, very clear that if they're range bound, is because the focus is on the Fed's cross asset. Let's also look at treasuries and everything else. Now, the Fed widely expected actually to cut interest rates by another 25 basis points today. The focus now is on the outlook for next year, as of course inflation decelerates more slowly than previously anticipated. And then we look at Trump policies when he comes in after January 20th. The S&P futures gaining 0.1%. The interesting bit, of course, is not only the 10-year yield, but euro dollar at 104.94, and then Bitcoin 103,000. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, traders, of course, readying for the Fed's final policy decision of the year, with the central bank expected to cut to 25 basis points. The focus likely to be on the outlook for next year as Donald Trump heads for the White House. Now, we're joined by Natalia Pipikina, head of EMEA Equity Strategy at JP Morgan Private Bank, and Bloomberg's Michael Sika. Thank you both for joining us. I mean, it's a big day, Fed Day. Last Fed decision of the year. I don't know whether it's almost a given that they cut, but there's going to be a lot of focus on the dot plot and what happens next.
Absolutely. Hello, Francine. Very nice to be back.
We agree with the market. The market is pricing 25 bips cuts. We think that the Fed delivers. But as you mentioned, it's all about the next year. It's all about the growth expectations, but also the pace of the cuts going forward, because we think that probably they will go into the quarterly cuts next year. So we expect around 100 bips cuts in 2025.
Yeah, and inflation's a bit stickier than expected. Is this because of structural concerns? Is it going to be accelerated by what Donald Trump policies could look like? Or is it just that it's just tough to get to that last mile?
Well, I think the market is quite concerned about exactly what you said, the growth expectations. And this is the very stark difference between what we're seeing in Europe and in the United States. It's the growth differentiation. And we saw that in PMI's data this week, where European growth is quite weak and momentum is very weak, but the US market is still quite solid. Consumption is solid, the labor market is solid, and that's such a big difference.
Yeah, and Michael, that's also playing out in equities.
Yes, it's playing out in equities. But what we've been noticing lately is that the market has been slightly uneasy going to the Fed meeting. The breadth is narrowing very, very fast in the US. You had like 11 or 12 days of more decliners than advancers. It's like a very rare occurrence. The number of stocks above their 200-day moving average is plummeting. So the rally, which is still holding, is holding because of just a handful of stocks, mega caps. So we're back to that period where mega caps are driving the S&P 500 and keeping the gains, while the rest of the market is really uneasy. And that's because next year is a bit uncertain. We don't know how much the Fed's going to cut, what's the path going to be, what Donald Trump's going to do, how much inflationary are going to be the next policies. So there's a bit of uneasiness there.
Yeah, there's a lot of uncertainty, Natalia, which is why, you're still positive on U.S. And when's the right entry point, though, for Europe? If you look at the two, it's still U.S. exceptionalism. And Europe the valuations are nowhere near where they should be, probably.
Yeah, in our 2025 outlook, we actually upgraded the United States and we downgraded European markets. When you look into Europe, there are so many uncertainties and weakness. The economy is quite weak. We're still waiting to see what happens with the stimulus in China, tariff fears, but also political uncertainty. If we see that some of those factors are starting to change, this is where we may become more positive on Europe. But so far, we're not seeing that. And we're seeing a very big difference between earnings growth in the US and in Europe. In the US, for example, we expect another very strong year, double-digit earnings growth, which is quite strong compared to even long-term average in the United States.
But if you see a difference, if you look at the Fed and the fact that there's going to be many more cuts in Europe compared to the Fed, can you play that in any way in the markets?
Potentially, but we need to see what that actually means for the economy. For us, this is the most important anchor for the earnings. If economy is actually a bit more resilient next year, we may see a bit of a flows coming back to the region. But so far, we're seeing that momentum is quite weak.
Michael, what are they saying about inflation? What are companies saying about inflation? Or are you seeing anything in earnings per share?
So at the moment, it's not a problem. It's like something, like it's a risk for next year. So we've seen there's a bit of tensions in the UK, there's a bit of tension in Europe, but it's not like a massive worry so far. You were talking about rate cuts. So the ECB is expected to cut like at least twice as much as the Fed next year. And that could be like a tailwind for European stocks. But at the same time, when you have a central bank that is cutting really aggressively, it's never a great sign for your economy. It also means that they are really scared that the growth is going to plummet and they need to do something about it. And that will be seen on earnings. We're discussing about the earning growth forecast for next year. So far, Europe is still like expected to grow almost as fast as the US. That seems a bit far-fetched, especially if we're having that many cuts and the economy is not doing well.
Natalia, one of the other themes that you've identified in your 2025 outlook is basically capital spending and capital investment. Where does that go to?
Yeah, we're seeing a lot of capital investment in 2025 in the areas like power, artificial intelligence. If you're looking into the US large cap stocks, they expect to spend another $250 billion next year. That's a very, big spending. We think there are a lot of sectors that benefit from it. Technology is the one that stands out, but also sectors like industrials, and utilities. So utilities is a new sector for us. We have upgraded it recently, and we think that the power demand has been quite stagnant in the last decades. And with the surgence of artificial intelligence, it just means that a lot of tech companies need a very reliable and carbon-free generation.
Given all of these, I guess, crises or possible sources of volatility, how do you make sure that your portfolio is resilient for what could be a choppy year?
Absolutely. This is one of the most important themes that we identified in our outlook, portfolio resilience, especially after such a strong 2024. So we are talking to our clients about finding diversified asset classes, for example, alternatives, infrastructure, real estate. These asset classes can actually provide you from potential risks from inflation. So we think that it can be a nice source of additional income to your 60-40 portfolio.
Okay, wonderful. Thank you both for joining us today. Natalia Libikina there from JP Morgan Private Bank, and Michael Psika, Bloomberg Senior Reporter for EMEA Equity and Market Strategy. Coming up, we speak with Thomas Buberl, the, of course, Chief Executive of AXA. He joins us for an exclusive conversation on the top concerns facing companies across the globe. That's coming up shortly, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back, everybody. Now, the insurance giant AXA has released its 2024 Futures Risk Report with climate change, geopolitical instability, and cybersecurity top of the list for the third consecutive year. Now, it comes with traders and policymakers navigating a period of heightened volatility ahead of a new administration about to enter the White House. Now, for more on all of this, Thomas Buberl, Chief Executive of AXA, joins us for an exclusive conversation. Thank you, Thomas, for joining us. I mean, there's a lot that could go right, and there's a lot that could go wrong in 2025. What are you most worried about?
I'm worried about, good morning, Francine, I'm worried about the fact that we have so many risks and also so many new risks. If you look at Syria, for example, this wasn't on our agenda 6 months ago, and that those risks are so interlinked that it's very difficult to make projections now.
So what does that mean for risk-taking, but what does it mean also for the psyche of a lot of chief executives when it comes to spending and investment? Is there a collective kind of wait-and-see situation that means that there's going to be a bit of contraction?
At the moment, you see many questions and the desire to create some logic and structure in all of these risks, which is almost impossible. I mean, for our industry, this is good news because we have high customer demand and can help our customers in dealing with these issues. But what we need today is really the so what for. What does it mean for business? We understand the risks, but then what are the implications and what are also the second and third order implications? Those are not clear, and I think that's where we all need to work together now as a community of chief executives and politicians to find our way forward.
I mean, in France, it's complicated trying to find a government. We have a new prime minister. We don't exactly know how he'll move going forward. That's François Bayrou. Does this political uncertainty continue into 2025?
It will certainly continue because the key issue at the moment is that there is no majority in the parliament. So any new prime minister will have a difficulty of finding a majority and also in particular finding a majority for a budget that instills financial discipline. So yeah, I do expect that this will continue. What it means for our business, I mean, AXA is in France, but AXA is not La France. And that's why, for example, we have 25% of our business in France, but only 15% of our investments. So we are a global business. And you see Moody's has, for example, downgraded France last Friday, but they confirmed our rating last night. So for us, this is a situation that is not comfortable, but is a situation as a global insurer that is absolutely bearable.
But what does it mean going forward? What do European businesses actually need in terms of investment to become more competitive and to really go on forth on the world stage?
I think Europe needs to wake up. Europe is surrounded by a lot of powers that have a very clear strategy and a very clear desire to succeed and to compete. And Europe is today still in a world of finding its destiny and finding its journey. And we need to wake up, we need to defend our model that has made us successful for such a long time and need to be crystal clear what are our priorities and who is putting them in place. And this is what is missing today.
Yeah, but do you need a strong Franco-German axis to make sure that it's strong enough to hold, but also strong enough to do foreign policy, to do financial policy in relation to Donald Trump in the White House?
I would say you need all of the above. What has always worked in Europe is a strong Brussels that is oriented towards a common view of Europe and strong chiefs in the different countries, presidents or chancellors, to also create the balance. We do not see that at the moment, and that's why also I believe that companies need to step up. The public-private partnership in discussion needs to get into a very different level.
Mario Draghi speaks about an 800 billion euro investment a year. How do you find that money?
So, I mean, first of all, I think it goes very much back to what I said earlier. This is that focus. So for the first time, I mean, Enrico Letta started it already, but for the first time, we have a number on the table. We have clear priorities on the table. So I'm a very big fan of this report. The question comes now, how to implement it. And there as well, only leaving it to politicians is probably not the right solution. When you think about all the COP meetings, politicians have discussed and companies have mostly implemented. Why not finding the same logic in the famous 800 billion packet?
So you also, what does this all mean for actually the insurance industry? I know you sold parts of the business off. You'll get, of course, this money from the AXA EM sale to BNP. What will you do with that money? Do you want to grow yourself?
So first of all, I mean, this 800 billion or investments in Europe would mean good opportunities because we've only sold the executing part of the investment decision, not the investment decision itself. Secondly, you're absolutely right. The sale will give us some money, which we will partially use to neutralize the dilution of earnings through share buyback, and there will be a little bit remaining, which we will use to strengthen the existing franchise.
In terms of what, M&A? So are you shopping around, and in what kind of markets?
Look, we have gone through a very profound transformation. We have a global AXA today that works very well. All of our plans are focused on organic growth. So we have no M&A budget, nor do we rely on M&A. If there is a good opportunity, we'll have a look at it, but there's no pressure.
But your deal with BNP seems to have kicked off something in terms of animal spirits in the asset management and insurance industry. Is that fair?
Yeah, that's fair, and I think it's also justified, because what you see in the asset management industry is a polarization of the industry. You see on the one hand that the liquid part is clearly shifting more towards passive and more towards size in passive, and you see that the illiquid part, so alternatives, real estate, private equity, private credit, is also shifting to franchises that offer all of them, and also very sizable. And so you cannot stay in the middle. And so we took the decision. We want to strengthen that business in Europe. We want to contribute to creating a European platform, and therefore the sale to BNP was the logical consequence.
Thomas, when you look at your top risks, I mean, again, what happens in 2025? There's cybersecurity, there's geopolitics. What are you most worried about that's outside of your control? And what are you most worried about that's inside your control?
So what's inside our control is our own risk-taking and is our own capacity and capability of execution. We have a clear plan that we need to put in place, and we are in control whether we do it or not. Where I'm mostly worried about is a risk that is not even so high on the agenda, and that is the risk of social cohesion. When you look today at the difficulties that we have around social cohesion and the broken social contract, and no attempt to rethink and renegotiate the social contract, this is what worries me most, far beyond geopolitics and cyber.
And does that get really much worse in 2025 if politicians don't think about it in the right way?
Obviously, because if you have budget shortages, you cannot distribute anymore the way you are. And if you look at our demography, if you look at our state of our health, you will see that things are worsening. I'll give you an example that shocked me personally. We are entering this segment in France because we want to make sure that everybody can have insurance. We've realized that 20% of all French can either not afford insurance because it's become too expensive, and or are excluded because they represent risks that are not desirable. And this will not lead us to a socially cohesive society.
There's a cyclone on the French island of Mayotte. How much is that going to cost?
Oh, it's far too early. I mean, we're still in the middle of understanding what has actually happened. The first visits have happened, but in France, the good thing is we have a good private partnership with the so-called NatCat pool, so where we accumulate funds in times where we have no natural catastrophe events. That seems to be far away these days because they happen all the time. But then we also have a pot of money that we can use to help people in need. And if you look at the pictures, it's terrible to see what's happening.
Thomas Buberl, thank you so much for joining us. That was, of course, the Chief Executive Officer of AXA for an exclusive conversation here in London. Now, coming up, Nissan and Honda are exploring a merger to better compete in the global auto industry. So we'll discuss that next, the mega merger. This is Bloomberg.
Fixed Income Fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, shares in Nissan surged the most in at least 5 decades as Bloomberg learns that the automaker has become the latest buyout target in Japan. It's exploring a merger with Honda to better compete in the global auto industry. Now, Foxconn, meanwhile, has also approached Nissan to take a controlling stake in the company. Now, let's get more with Bloomberg's global card czar, Craig Trudell. Craig, thanks so much for joining us. I mean, this is huge. Like, how much of this was actually expected?
Yeah, I mean, to be clear, Nissan is not a sort of, prized asset for either of these companies. This is a matter of a company that's, deeply in trouble, that has had long-standing issues that I think, really started to rear their heads when Carlos Ghosn was pushed out, when he was trying to combine Renault and Nissan. And I think there was real concern in Japan about, just how damaging that was going to be. And so years ago, we knew that the Japanese government was looking at this idea of Nissan being resistant to combining with a foreign car maker, and seeing in Honda some potential for these two companies to potentially be good partners.
Craig, we're just seeing this Bloomberg headline, which your team, of course, Chasen wrote up, but Nissan's biggest shareholder, Renault, is said to be open to Honda talks.
Yeah, and I think that makes a lot of sense because Renault and Nissan, of course, have had real issues in the years since Ghosn was pushed out. Renault still has a significant stake in Nissan. I think it's absolutely safe to say that these two have drifted apart in dramatic fashion, but they're still tied together by this really significant cross-shareholding. If you're Renault and you see some potential for that shareholding that is very depressed in value to recover a little bit by them ending up in the arms of a company that they're more willing to get taken over by, you maybe can recoup more of that value than you would otherwise.
Craig, in 20 seconds, I mean, does it make sense actually combining two companies that are not doing great?
I think it potentially can safeguard Japanese interests and remove the worst case scenario for Nissan. I do think there's some real questions about how competitive this combined company can be if there's not further rationalization. There's a lot to fix at Nissan.
Craig, thanks so much. Craig Trudell there with the very latest on this possible mega merger coming up. But we talk about Russia and, of course, Ukraine. This is Bloomberg.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race. And Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, these are your top stories. Traders await the Fed's final decision of the year, pricing in a quarter-point cut. The focus will be on the rate path ahead. Bloomberg understands that Nissan's biggest shareholder, Renault, is open to merger talks with Honda, with iPhone maker Foxconn also on the hunt for a stake. Plus, UniCredit raises its stake in Commerzbank as the chief executive. Andrea Orcel keeps up his pursuit of the German lender. Now, onto politics, geopolitics, and Russian authorities have detained a Uzbekistan national on suspicion of killing a top general in a Moscow bomb attack. Now, Moscow says he'd been recruited by Ukrainian security services to carry out the assassination. Well, let's bring in Ross Matheson, Bloomberg's EMEA news director. Ross, thank you for joining us. So does this accusation point to a new phase in the war?
Well, it's interesting to see that Russia is now directly accusing Ukraine of being behind this attack, as you say, detaining an Uzbekistan national, saying he was passed a device by Ukraine's security services, that he rented a car with a surveillance camera so he could monitor the apartment that this general was in and then detonate the device, that he was promised safe passage and money if he did so. Of course, the source was telling us yesterday that Ukraine's security services did indeed carry out this assassination, which would be an escalation, obviously, in this conflict between Russia and Ukraine, inside Ukraine, where we see Ukrainian security services now targeting senior officials in the Russian military inside Russia itself. So obviously assassinating this Lieutenant General Kirillov in Moscow. So does that represent a change in tactics by Ukraine, possibly a move towards more of a decapitation strategy around senior figures in the Russian military, but again, also about just sort of strengthening Ukraine's position, sending a message to Moscow that as and when talks may happen on this conflict, as it seems to be heading towards, that Ukraine's going to come to that negotiation, at least with some of its own demands.
Ross, how significant is it if Donald Trump's special envoy does indeed travel to Russia?
Well, it's interesting to see this news that Keith Kellogg is saying that in next month, obviously around the time or after Trump's inauguration, that he's going to travel to Kiev and possibly also to European centres like London and so on, but that he'd be open potentially to visiting Moscow if an invitation was extended to him to do so. And that would be really significant because given the level of US sanctions on Russia, having a high-level US official travel there for meetings versus meeting Russian officials outside Russia. And what does that send in terms of a signal? Well, it shows again very clearly how much the incoming administration wants this war to be brought at least to a ceasefire, if not to a full halt and some kind of resolution and concern, no doubt, that would raise in Ukraine. Like, how much is Russia going to sway or try and sway the US on this in terms of their own position, what they would want from some kind of ceasefire deal? And again, the big question obviously being Ukrainian land. And does Russia, in a meeting like that, inside Russia, very much sort of push the US to agree to allow Russia to keep the land that it is occupying at the moment inside Ukraine? So it would be very, very interesting to see if something like that did actually happen.
Ross, thanks so much. Bloomberg's EMEA News Director, Ross Matheson. Let's get more of Elizabeth Braw, Senior Fellow at the Atlantic Council. Elizabeth, thank you for joining us today. When you look at how Donald Trump can change actually what's going on in Ukraine, in which ways will it change it?
He is so idiosyncratic that he can say one day one thing, one day another thing the next day. But I think what's important about this assassination of the Russian general is that the Ukrainians are showing that they are not in a hopeless situation as it has seemed, or as in a difficult situation as it has seemed recently. They are able to take the initiative in unexpected ways. And frankly, this is what Trump likes. He has said several times over the years he doesn't like losers. And Ukraine is showing they're not a loser. So I think this will influence how he thinks about Ukraine. Right. And that really matters, because in his world, it really is what he thinks that matters.
And so was this a move to impress Donald Trump, or was this a move to embarrass the Russians?
It was both, and that's what makes it so clever, and also because it was so unexpected, because it brings the war closer to the Russian leadership, obviously, but also embarrasses them, because it's now clear to the whole world that the Russian authorities are not able to look after even their highest-ranking officials in their homes and the walk to the car, which is where this general was assassinated.
How will Russia retaliate?
It will retaliate. Of course, it's difficult to predict where that will be, but clearly somewhere in Ukraine, clearly somewhere on the battlefield. The Ukrainians are not as innovative as the Ukrainians when it comes to thinking up unconventional moves in this war. So the Ukrainians thought up the incursion into Russia, completely taking the Russians by surprise. The Russians haven't been able to be as innovative, but we'll clearly see even more pressure on the battlefield. I don't think there are many countries that can help Russia in that effort. We saw them resorting to North Koreans recently. Syria is not going to be helping them. There are very few countries that can help them.
Elizabeth, when you look at the way forward, again, what will be the main thing that Volodymyr Zelensky wants to achieve? Because if he's so reliant on the U.S. right now, what's the way forward for him?
The way forward really is to get into Trump's good graces by showing that this is a fight worth investing in, because Trump has this almost visceral dislike of people and countries he perceives as losers. So if Zelensky can show that Ukraine has a chance of winning this war, of continuing to take the initiative, of surprising the Russians, that will impress Trump. That will convince him that it's worth keeping that steady supply up of weapons deliveries, which is what Ukraine needs.
But tactically, what's the best case scenario actually for Ukraine right now? That there's a peace deal that's also orchestrated by the U.S., or can they actually think of winning this?
I think the realization has set in that Ukraine may not get all the territory back that it had before Crimea was annexed by the Russians in 2014. And that is a very painful reality, but it's less painful than having to contemplate conceding territories lost since February 2022. I think one aspect, or one little development, or not so little, one important development to watch is what happens in Germany. Right. How strong the AfD, how strongly it does in the next elections, because they feel very strongly that there should be talks between Russia and the United States in the first place, not involving Ukraine. So how well does the AfD do in the elections, and other parties that may support that sort of approach?
I was also quite perplexed at hearing about 50,000 North Korean troops right at the border enrolled by Russia. What's China's thinking on this?
China is the frustrated patron of North Korea, clearly North Korea's patron, but one that can't tell the North Koreans what to do. They strike their own deals, and then China has to just accept that that's what has been done. The North Koreans will have extracted a price for this, and that's why it's so important that South Korea remains stable, because we don't know what is coming South Korea's way, because the North Koreans will have received something from the Russians in return, and that something is going to be directed against South Korea.
I mean, I was thinking, I don't know whether, al-Assad actually is a distraction for Vladimir Putin in Ukraine, but does it really show the fact that he didn't support the Syrian president? Does it really show how weakened Putin is?
He's overextended, and this is the risk of invading another country. You are in charge of deciding whether to invade, but you are not in charge of deciding whether you'll win. You are one of two parties to that decision, and the other country can put up a bigger fight than you expected, and that is why Russia is now overextended and wasn't able to support Assad. It's looking weak as a result, but Putin clearly made the calculation that keeping Assad in power would be so resource intensive that it would affect Russia's ability to win the war in Ukraine.
So interesting. Thank you so much, Elizabeth Brother, for joining us today, the Senior Fellow at the Atlantic Council. Now, Israeli officials believe that a ceasefire in Gaza is more likely now than at any time in the past year, with a potential deal to free hostages and increase aid to the region. A working group from Israel is in Qatar to reestablish relations with mediators, and senior cabinet members have expressed optimism about a potential truce. Now we'll be speaking with the U.S. Secretary of State, Antony Blinken, about the Middle East as well as Ukraine, as the foreign policy transition under a second Trump administration. Don't miss that interview tomorrow, 1:15 p.m. London time. Coming up, we'll dive deeper into the big banking story of the morning. Commerzbank shares rising as UniCredit hikes its stake to 28%. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Well, Commerzbank shares have risen as UniCredit increased its holding in the company to about 28%. The move ratcheting up the chief executive under Orchel's pursuit of the German lender. Now let's get to Bloomberg's Claudia Cohen in Paris. Claudia, thank you for joining us. So will UniCredit offensive on Commerzbank Wake Up European Banking Consolidation?
Well, we think so. We think so because with the Orshal move, is going all out, is going for Commerzbank, despite we need to say that, despite the German government backlash a few months ago, maybe he's hoping that with the federal election in Germany in February, maybe, we'll get more chance, and it's still on a local deal in its Italian domestic market with Banco BPM. So the two main questions will be how will governments react, like the German government, the Italian government, and also the second one will be how the biggest European competitors will react, because as we recall, to talk about France, earlier in June this year, Jean-Laurent Bonnafé, BNP CEO, said that, he didn't think that European banking consolidation could happen. So, like, Orshal move is just disturbing all the CEO strategies in the banking sector.
So let's also shift focus to Crédit Agricole. They have a new chief executive. Who is he, and what are his main challenges, Claudia?
Yeah, they do. So it's Olivier Gavalda. He's Crédit Agricole veteran. He's been there since, I think, around his 20 years old. So he worked at the regional banks, like he knows the company extremely well. So it was kind of a natural choice for the company, I guess. And his main challenges would be that we need first to elaborate a 3-year strategic plan starting in 2025 in a really disturbing French market. And also, as we mentioned just now, we need to rethink Crédit Agricole's strategy in Europe, because Crédit Agricole has many interests in Italy, for instance. It's its biggest market after France.
So why has Moody's downgraded the French banks?
Well, it was quite of a predictable move, because obviously Moody's, they always want to keep a notch between the sovereign and the credit bank, in the country. We saw that market didn't react that much to the news this morning, because obviously with all the political turmoil happening in France since the summer, a lot of it has been already integrated in bank stock. So we'll see. I would say that the bigger risks are more in the longer term, if the economy slows down, if households decide to save more, and if French companies decide to freeze investment next year.
Claudia, thanks so much for joining us. Claudia Cohen there on the very latest from Paris. Now, UK inflation risen to an 8-month high in November, drifting further above the Bank of England's 2% target and supporting expectations that it will hold interest rates at its final meeting of the year. Let's get more from Dan Hansen of Bloomberg Economics. Dan, we're here. It's like the final meeting. I don't know whether it's a good or a bad thing, but actually there's quite a lot of data to get through. Well, I mean, what happens after tomorrow?
Yeah, there's been a lot this week, and obviously we'll get the final decision tomorrow. I mean, I think what we've had yesterday and today makes it almost certain it's a hold tomorrow.
Right.
So it's much more about what they say about the future, and even there, I don't think we're going to get a huge amount more than we got in November, to be honest with you. This idea about gradual cuts, all the data we've had over the past week and since November, it supports that view. So I think tomorrow is going to be, I know as a news organisation we're meant to make it quite interesting, but I think it's going to be quite boring, to be honest with you. They're going to sort of say, look, we're in a good place. We're going to look at it again in February when they have a new forecast as well. Yeah. We know they prefer to sort of move with that forecast in hand. So I think for us at least, we're going to get a cut in February. That's the next point at which things move, and probably stick with quarterly cuts in 2025.
I mean, there was a big market move, right? My head was kind of spinning looking at market expectations.
Yeah, it was massive.
What happened?
I mean, it was a surprise. I mean, everyone thought wage growth was going to accelerate, just not to the extent that it did. And it was particularly the private sector number that jumped, and that's the thing that the Bank of England's really, really focused on. I mean, it felt to me outsized, and the reason I say that is because if you look back probably over the last 6 months or so, I'd say the bank has become increasingly insensitive to data surprises. They've been willing to look through. We've had upside and downside surprises over the past 6 months, as you do with all data. Yeah. And that's, if you think back to 2023, when they moved in response to some inflation surprises, we got a late cycle 50 basis point hike. We got a surprise hold in September 23. And that was on the back of data that sort of surprised the upside and to the downside, respectively. Over the course of, well, over the second half of this year, they've been a little bit more tolerant of data surprises and have been saying, you know, we've got a strategy. The data broadly supports that. And I think the data we've had over the past week and since November, as I say, supports that strategy still.
Then, I mean, how much will they, be influenced by what the Fed says today, longer terms of dot plots and expectations, given that you have a new U.S. administration that, frankly, could change everything for inflation? Oh,
yeah, absolutely. And I think the question for 2025 is going to be, not just for the Bank of England, but also for the Fed, is where's the end point? And this idea about the neutral rate that everyone gets very sort of het up about. This idea of the terminal rate, the rate that neither speeds up nor slows down the economy. And I think the risk is that is higher than everyone sort of would ever think. It's, perhaps closer to 4% than it is to, say, 3%, which is where the Fed's dot plot, its long-run projection is at the moment. It's closer to 3% at the moment. So I think that'll be the question. And because the UK is a price taker in global markets, where the Fed says neutral is really important for the Bank of England as well. So I think there's going to be a lot of focus on what the Fed says today and in January about how far they think they can cut rates in 2025, and the Bank of England will take a signal from that.
Dan, thank you so much. Dan Hansen there from Bloomberg Economics. Now, coming up, things go from bad to worse for Brazil's deepening fiscal crisis, with traders even piling into hedges against sovereign default. So we'll have a full roundup of the top stories on that. That's next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
But I think they need to bring it down a little bit. They just have to be more careful because the economy is stronger than we thought 3 months ago, 6 months ago, but it still has potential weaknesses. You and I haven't even talked about what's going on outside the United States that could affect the United States. Not tariff stuff, but wars. You know, what happened in the Middle East this the week, what happened in Korea, what's happened in Germany. All these political changes could impact the United States.
Well, that was the Bank of America Chief Executive Brian Moynihan there speaking to our David Weston. Now, investors losing faith in the Brazilian government's ability to contain a deepening fiscal crisis. Traders piling into hedges against a sovereign default, with the sell-off actually extending across the country's currency, stocks, and bonds. Well, let's bring in Creighton Harrison, Bloomberg's executive editor for Latin America. Creighton, I mean, thank you for joining us. This actually seems like it's really spiraled really quickly. So what's the background for the crisis, and why are investors so skeptical about President Lula?
Yeah, like many market sell-offs, these things tend to build up over time and then sort of pop all at once, right? And this has been one of those. Lula, in his first term, I mean, he's always been, of course, the consummate leftist. He believes in big social programs and lots of government spending. But when he was president the last time around, he sort of balanced that with some pragmatism, and markets grew to sort of understand and respect the way he could do that. There was hope when he came back to the presidency that he would continue in that vein, but there was also anxiety that maybe he wouldn't. And so those forces would sort of, push against each other throughout the first couple of years of his terms. He would say something that sounded too spendy and markets would freak out. Then the finance minister would go remind him that markets were freaking out, and he would sort of calibrate it. He has been calibrating less and less now. And over the past couple weeks, he presented the spending cut proposal that was supposed to calm markets, but he balanced it with a tax break for the less fortunate in Brazil. That freaked markets out and made it seem as if he wasn't serious about balancing the budget, which is sort of cascaded from there.
Creighton, I mean, the other thing is, like, Brazil's central bank is intervening quite aggressively.
Yes.
But it's not doing much for the currency.
No, I mean, $3 billion worth of intervention in the past 24 hours alone, I believe, and it barely budged the real. We're going to see what happens today very shortly. But what we're getting to and what the market is really concerned about is a term called fiscal dominance, which I'm sure you're familiar with. That just means there's only so much the central bank can do, that at the end of the day, what the market is concerned about is the government's ability to balance the budget, and only the government can really resolve it.
So what will it take for Brazilian markets to be, to rebound, I guess?
Well, Lula could pay attention to the markets. He has done so in the past and has, changed tack. And he could see the charts that I'm sure his finance minister and his central bank president are showing him, and decide to take a different course or moderate his language even a little bit about what he wants to do in the future. The problem is it's a little bit out of his hands. His spending bill is already in Congress, and of course there are lawmakers who are already, carving out some exceptions to the plan and in ways that would make it harder to rein in spending.
Okay, so watch the space.
Watch the space.
Creighton, thank you so much. Creighton Harrison there, Bloomberg's executive editor for Latin America. Now, tomorrow we'll also be speaking with the U.S. Secretary of State, Antony Blinken, about the Middle East and foreign policy under a Trump administration. So we'll see his thoughts as we near the transition, with inauguration January 20th. Up next, Bloomberg Brief with Manus Cranny in New York. Of course, the big market event of, well, I'd say not the day, actually, I'd say probably of the month, is the Fed. Not what happens today, but how they then lay out the rate path ahead for 2025. You can see markets for the moment a little bit tepid, waiting for more market updates and that dot plot from the Fed. This is Bloomberg.
about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, you know, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning from our global headquarters in New York. I'm Menace Training. Danny Berger is off. Welcome to Bloomberg Brief. Let's set that agenda. How hawkish a cut can it be? The FOMC meets with consensus building for a 25 bip cut. The game of survival in Japan, Nissan explores a merger with Honda as Honhai enters the fray. The Biden administration set to launch a trade probe into Chinese chip makers in the coming days. Good morning. Danny Berger has a couple of well-earned days break at the moment. We're looking at equity markets eating out the smallest of gains. This morning up by 1/4%. We're counting down to the third cut of 2024. By the way, the funniest fact of the day, I'm sure surveillance will troll this. The Dow up for the 8th day in a row, the longest, down for 8 days in a row before this morning, the longest losing streak since 1978. The consumer is strong. Retail sales were fine. Ed Yardeni says consumer wages and wealth are strong. The bond market is ground zero for us today. Let's roll it over and have a look at the bond market because you're just off a 4-week intraday high yesterday in the 10-year paper at 440. We're looking for, the risk is a hawkish cut, and the risk is that the dots actually move from indicating 4 cuts next year to 2. That's according to RBC. But we're also keeping an eye on NVIDIA this morning, rebounding after going into correction territory and hitting the lowest level since October. Some say NVIDIA's pain is Broadcom's gain. Tesla falling as its China factory head Song Gang is set to leave the automaker this week, according to people familiar with the matter. Micron is rising as it's set to report results after the market closes today, which could show a tailwind for AI demand. In just a few moments, we'll catch up with Jane Foley from Rabobank, and later this hour, Citi's Andrew Hollenhurst joins me around the desk. We're going to start the conversation today about the third rate cut potentially from the U.S. Federal Reserve. And in terms of that, you know what? Let me just bring you a little bit of breaking news here coming in across the Bloomberg terminal. This is what we've got for you. U.S. graphite firms seek 920% duty to thwart China on the EV material. So this is a breaking news headline. We're at the beginning of some big evolution in terms of actual tariffs and the threat of tariffs. So this is U.S. graphite firms seeking a 920% duty to thwart the China EV material. I mentioned the dollar. Just have a look at this. This is positioning in the dollar, and I can tell you that the CFTC, the hedge funds, have the largest net long in 7 months going into this particular FOMC. As I say, the consensus is for some kind of a hawkish cut. There's the powerful trajectory of the dollar. It's crushing everything in its path in G10 and in the emerging market space, the Kiwi and the yen under a lot of pressure. Joining me now, it is Jane Foley. Jane, good morning to you. There is doubts about how much further the Fed can cut. How shallow a grave will the rate cutting cycle be in 2025?
Well, good morning, Manus. Certainly from Rabo's point of view, it could be very shallow in 2025. Indeed, after today's expected 25 basis points cut, we think there may only be scope for one more in 2025, probably in March. Because if we look at the data right now, and we've seen the market really react to this in recent weeks. So we've seen that resilience in the US economy. And look at the CPI data last week. Okay, it came out as expected, but there were elements of stickiness in that. And then, of course, going into 2025, you layer on the inflationary impacts of tariffs and maybe of tax cuts as well. So, how far can the Fed go? And we just think not very far. But the interesting thing about that is that the market, coincidentally, as it's been sort of pricing out Fed rate cuts for next year, has been potentially pricing in more for various other central banks. I mean, look at the aggressiveness, for instance, of the Bank of Canada or the RBNZ or the SNB, for instance, and potentially the ECB too. The markets has been pricing in more interest rate cuts from the ECB. And so in a way, for some of these economies, a weaker currency, assuming inflation remains benign for them, a weaker currency could really help their exporters, particularly against the threat of tariffs.
So, I mean, if you just reflect back on the SNB president, we still have ammunition left, and nobody likes negative interest rates. But of course, we know that they have the propensity to work. Give me a landscape of what an FX war 2025 looks like.
Well, I think from the SNB, I mean, inflation in Switzerland's been benign for months, and their Swiss franc has been holding at really quite strong levels versus the euro. So they've got every incentive to try and talk their currency down. Now, they know with the Swiss franc, there is this additional headwind of potential safe haven flows, which they've been battling with on and off for decades. So there is that too. And I think for the SNB president, his comments last week, and he's made similar ones once before, about possibly using negative interest rates, is again this verbal intervention to try and get the market into this mindset that they could go a lot further. Maybe we shouldn't be buying so much Swiss francs. So it's all about this sort of combat, getting ahead of market thinking.
We're also going to get guidance from Chairman Powell. There's the euro against the dollar. Obviously, we're just talking about the Swiss franc in the last conversation. There we go, 89.37. Language is important because the tone, the language, and the intonation from Powell is as effective, perhaps a little bit more effective than the dots some people would say at the moment. If I take my mind back to July to November 2023, the last time we went into a grand pause, the word careful was used a lot more. Nobody's going to directly perhaps use the word skip or hold. Pause has been used recently. How important, or how important is that nuance of that word careful in terms of the guidance?
It is really important, and we've had this from Powell, very recently, that the Fed has got scope to be, I think, cautious. Perhaps it might have been what he said, and so he's already implied that, and I think that's what the market has been pricing in these last few weeks, the anticipation that he will repeat that sort of tone. And of course, the economic data would support that view. There needs to be no particular rush. I mean, back in the summer, it appeared as if the market was, the jobs market in the US was slowing perhaps a bit more rapidly. But since then, it's like, okay, it's slowing, but it still remains relatively resilient. So there is ample scope for the Fed to be cautious. And that's exactly why the market's been pricing out some of the interest rate cuts that it had, penciled in just a couple of months ago.
So 25 basis points, the tone could shift more aggressively to pause. Is that injurious to the dollar? Look at that CFTC positioning that I just showed you at the start of the show. That is not an exhausted long position, and that's the consensus that I've had from Barclays and from a number of other people, that there's still miles in the dollar. There's still mileage in the long.
And I would agree with that. And, you know, we can talk about the Fed, we can talk about the US economy, but we also need to talk about everything else. Yeah. You know, and you look at the position, you know, of tariffs, and you look at the shadow perhaps cast over trade from many exporting countries. And, you know, you have this view in the market that many emerging markets are not going to see the investment perhaps that they may have done if this step up in tariffs wasn't there. So this real concern perhaps from emerging markets. And then you look at the troubles that Germany is having right now with its production, with its structural difficulties, the headwinds that it's been facing since the energy price crisis. And you think, well, the ECB has been turning its attention towards growth. Inflation in the Eurozone appears to be far better behaved. And so from that point of view, it's like, well, you know, can the euro really rally? Does anyone in Europe want the euro to rally? And so from that perspective, it's not just about the dollar fundamentals, it's about the relative weakness of fundamentals elsewhere as well.
And it's interesting, you know, you've got the real at a record low. You've got more pressure, political pressure on the Canadian dollar, Jane. I mean, this is the dislocation for 2025. It's not just the asset allocation to the United States of America. It's the political dislocation everywhere else. So with that in mind, you know, where does the dollar outperform the most into 2025 on your call?
Well, you know, I think it will be in emerging markets, and, you know, and perhaps we, you know, looking at the example of the Brazilian real, but within the G10, there is the possibility that the dollar can outperform all of the other G10 currencies, perhaps with the exception of the Japanese yen. And that is why I think tomorrow's Bank of Japan policy meeting is probably going to be the most interesting one of the week, because the market's expecting steady policy tomorrow from the Bank of Japan. But it needs to be, I think, a hawkish hold from the Bank of Japan, and an indication that they're prepared to go in January, and an indication that they're probably prepared to keep on hiking back up to the neutral rate of interest progressively through 2025.
Now, this is where it gets spicy, isn't it? Because the market's pricing, 18-19% of a hike tomorrow. You say that's a little bit of a low tail, but the consensus is that they will remain on hold. What is the risk, the real risk, that you see another flash redux of what you saw on August the 2nd and through August the 5th? The yen rallied by over 6%. That was a shakedown moment in FX. Do you expect more of those in 2025?
Well, I think that was extreme in the summer, partly because positioning was so extreme. You know, the world and his dog were all in the carry trade. They were all short the yen. I don't think positioning is as extreme now. You know, and the other factor is back then the market was still thinking recession for the US. So you know, that was part of that mix as well.
Yes.
So I don't think we're going to have an extreme moves. And a third factor, if you like, is Ueda is much more conscious of perhaps not creating that much volatility. I think there was probably pressure on him from the Ministry of Finance with respect to that move. So I think he wants to communicate a little bit better. So I think we're going to have volatility, but I don't think we're going to have something quite as much as we had in the yen in the summer.
You're stealing my hopes for a VAR shock, Jane. That's not good. I love a bit of vol and a bit of a VAR shock. It gets everybody to sit up and reappraise where their risk tolerance is. Jane, thank you very much. Happy Christmas, happy holidays to you. Jane Foley there at Rabobank. Other stories trending on your Bloomberg terminal this morning. This is what we got for you. A Defense Department spokesman says that none of the mysterious drones reported over the skies of the Northeast are being flown by the Pentagon, or, for that matter, are part of a secret government test. The White House has assessed that the sightings are not deemed to be of national security or public safety risk. Elliott Investment Management is suffering an exodus of talent after it's becoming more difficult to pitch smaller deals, as it has become one of the largest hedge funds. It also brings into question who might ultimately take the reins of the firm that was built by Paul Singer from just $2 million of assets in 1977. You can grab that story on The Big Take. Great read. And the Biden administration is set to initiate a trade investigation into Chinese semiconductors in the coming days. It bolsters the U.S. chip industry, has been a key focus for Biden. who has taken aggressive steps to limit the advanced U.S. technology from being exported to China. President-elect will be in office by the time this investigation concludes. Coming up on the show, Nissan and Honda are exploring a merger to better compete in the global auto industry. Renault keeps the door open. We discuss the triangulation of the auto industry on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Honda's perspective, the biggest benefit is actually the scale. I mean, currently, under the current management, Honda has been chasing some of the collaboration. And the biggest scale, clearly the GM partnership is one of them. They've been working with the Sony recently on Afrila brand. There has been clear change on the company's, the management on focus on the scale and the operation. I guess that's what Honda is expecting to gain from this partnership.
Shares of Nissan surged the most in at least 5 decades as Bloomberg learned that the automaker has become the latest buyout target in Japan. Nissan's biggest shareholder, Renault, is seeing its shares rise after the news broke. The French automaker is open to the two companies pursuing that merger. Craig Trudell joins us. He leads our auto coverage globally. Craig, we'll deal with the Renault portion at the moment. I mean, they have a substantial holding and legacy with Nissan. But I want to understand just how desperate a moment this is for Nissan and why perhaps there's such political push to put these two auto beasts together right now.
Yeah, you mentioned, this is the biggest intraday gain for Nissan in decades. That's partly a function of just how far this company has fallen and so quickly. We've seen a dramatic deterioration in this company's business. And I think there was some real concern in Japan about, the sort of long-term viability of this company when Carlos Ghosn left the picture and, things really went sideways for the Renault-Nissan alliance. And I think there was a sort of inclination to try to drive this company into the arms of one of its Japanese partners. And you have a situation where much of the industry has been, consolidated really by Toyota, where they have cross shareholdings with virtually everybody else. And Honda was sort of a natural candidate. I think Honda was really reluctant years ago to sort of entertain that push on the part of Japan's ministry. But I think there is a situation at this point where Nissan is really in such dire straits that perhaps the push on the part of the government has only become more important to really sort of essentially put together a rescue for this company at this point.
So let's just talk about the Renault part of this relationship. They've 34% holding, haven't they? Nissan, they've got 34%. It's a joined up adventure with Mitsubishi. They are open to this. Why is this? I mean, post Carlos Ghosn, this relationship has soured time after time. So Renault happy to perhaps see something stronger come out of this?
Yeah, I think it's a case of, it's fascinating because this alliance, there was, it really was the case for much of it that Renault was the weaker link of the two, right? And I think we've seen this real change just in the last couple of years where Renault has stabilized, but as was the case with Nissan in the past, whereas, for Nissan, Renault was kind of a weight around its neck. The tables have really turned. And so you've seen Luca De Meo really sort of gain some traction with turning his company around, at least getting it to a point where it's healthier and better able to compete. There's a lot, a few years ago, there was concerns about Renault that are sort of, reminiscent of how we were talking about Nissan now. We're not hearing those concerns now, and yet Nissan's woes and the amount of capital that Renault has tied up in Nissan, it's been a weight around their neck now.
Yeah, that great moment of perhaps realizing some equity or perhaps reducing their position. Craig, thank you very much. Craig Trudell on the very latest about Nissan and Honda, the deal in the making. From New York, good morning. It's Bloomberg Brief.
You missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Time for your front page news. This is what's making headlines around the world. We kick it off with the Washington Post, leading with Luigi Mangione. The suspect in killing the United Healthcare CEO, Brian Thompson, has been indicted. The 26-year-old was charged in New York with 11 counts, including first-degree murder. Prosecutors say the shooting was a premeditated act of terrorism. Up next, Financial Times. Microsoft bought twice as many NVIDIA AI chips as its rivals this year. It's estimated that it purchased 485,000 of NVIDIA's Hopper chips. That put Microsoft way ahead of NVIDIA's next biggest customer, Meta. They bought 224,000. And on Bloomberg, Bank of America, CEO Brian Moynihan says regulators need to reassess and relax the rules around banks. The comments echo executives across Wall Street calling for less regulation and more business-friendly policies. What exactly will that mean? Let's take a listen to what he had to say when he sat down with Bloomberg.
If we were sitting here last year, our team, the research team, Candace's team, had a soft landing, no landing predicted, and a lot of people say, oh, that's very optimistic. And matter of fact, we went from that would have been like a 1% GDP growth rate this quarter, and we're going to have 2.5 or something like that. So we've moved up from abnormally, from positive but low to now higher than trend, higher than average. And so that means the economy is not having a balance, anything. It's just going on this normal growth trend, which is good news. If you think about it becoming overheated, I think all the policies are yet to come in. There's enthusiasm, there's discussion, but everything's still out there until the policies get enacted. Our team, when they look at tariffs, they say, well, if tariffs are offset by better regulation, they'll kind of even each other out. But even given their knowledge of President-elect Trump's policies, they are still predicting next year's a 2.5% GDP growth. They predict the Fed cuts rates a few times. If the inflation's moving down and we can grow this economy, that's actually not a bad place to be, honestly.
Does this economy need any fiscal stimulus at this point? And it looks right now like the so-called Trump tax cuts will get extended. And also, candidate Trump is talking about a lot more tax cuts. And given the fact that we're above a trend on growth and we're close to full employment, do we need any more stimulus?
I'm not sure you need more stimulus, just like we didn't need the stimulus probably in 21 because the pandemic goes through the system. But the question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are. And that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. And he's a markets-oriented person. He knows that if it gets too far out of line. We just ran, for the last fiscal year in the United States, an operating deficit of $1.8 trillion, which is equal to the entire GDP of the country of Australia. And so we got to realize that the impact we have if we don't get this debt back in line. So I think everything on one side has to be governed with whether to do on the other side to offset it and whether it has that much effect. Right now, the economy is moving along. Consumers are spending. It's up for the 2-week period around the holiday, Thanksgiving holiday. It's up 5% over last year. That is good and solid. That is not overheated at all. But that came off the lows a little bit this summer, where I was a little nervous that they were going to let the consumer drift too far down. So between interest rates being cut a little bit, between the enthusiasm around the election, the markets being up, the consumers are spending more and telling us they're going to spend more for the holidays, which is good for the general economy. We got to keep them in the game not by overstimulating, by overdoing, by keeping the game just by getting a good core economy going with good deregulation activities, good tax policy, good immigration policy. These are hard things, but I think they're off working on them.
Some warnings there from the Bank of America CEO Brian Moynihan on the fiscal situation here in the United States of America. On Fed Day, we'll count you down to the FOMC decision from Bloomberg.
this real momentum from Wall Street? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. How hawkish a cut the FOMC meets with a consensus building for 25 basis points. It's all about the guidance. The game of survival in Japan, Nissan explores a merger with Honda as Honhai enters the fray. And the Biden administration set to launch a trade probe into Chinese chip makers in the coming days. So we're counting down to the Federal Reserve's third cut of 2024. People are concerned about breadth. You've got a nice take higher on these equity markets. I'll leave it to surveillance to troll me. The reason I put the Dow up there, it's managed to turn things around. Down for the 8th day in a row, the longest losing streak since 1978. Where were you in 1978? There is a lot of concern about breadth, but roll it over to the bond market, ground zero potentially for a little bit of volatile reaction today. You're just off a 4-week running intraday high in the bond market, just over the 440. The risk is the dots, how relevant are they? How material will they help you in the guidance? But there's a consensus out there that the dots may be moved from 4 to 2. Don't forget, bond vigilantes are hunting for somewhere to attack. Bear that in mind. As I say, it is Fed decision day taking center stage. And Citi's Andrew Hollenhurst, looking ahead to the rate path for next year, says this. Cooling inflation, slowing job growth, if continued in the upcoming data, would lead to a faster pace of rate cuts than is currently being priced by the market. A popular narrative is that the economy and inflation will reaccelerate due to animal spirits evident in stronger survey data. Andrew joins me now. Andrew, good morning. Good to see you. I wonder, have we and the market just got ourselves in an overly hawked up position? Because the market says 2 cuts next year after today.
Yeah, I think the expectations going into this FOMC meeting are that, yes, there'll be a 25 basis point cut, but maybe the messaging from the Fed is that they might slow their pace of rate cuts, that this might be a time when the Fed gets more worried about upside risk to inflation and less concerned about downside risk to employment. And I think relative to that market narrative, relative to that pricing of, like you're saying, just about 2 rate cuts next year, the Fed can surprise dovishly here. So I'm not saying that they're going to be saying that January is definitely going to be a cut, but they also probably won't be saying that January is definitely a pause. And that's what the market is pricing right now.
How does Powell thread that needle? I mean, if you look at some of the language, I mean, you know, skip and pause and careful. Those are the 3 that I think that we've done a bit of research on. Pause has had elevated word search when we look at the headlines. But careful takes me back to when they last went into pause, which was in 2023. So is that's the kind of narrative you think we get from Powell?
I think that's the language we hear from Powell. That's a really good word to use if you don't actually want to say something, but sound like you're saying something. You want to be careful. You want to be cautious. You want to provide the monetary accommodation or restriction that's appropriate for the economy.
Right.
No one would disagree with any of those things. Of course you should do all of those things. That could be a 25 basis point cut. That could be a pause in January. They're going to leave those options open.
Look, this is about calibration. You know, the market recalibrates so much more aggressively than the Fed. Look, in the summary of economic projections plus the dots, I just want to get your sense. A lot of people say, oh, they're of no value because we simply, or they're of limited value because there are many unknown knowns into next year between tariffs and taxes and deportations and immigration. If they dramatically downgrade, how significant a downgrade in the dots are you expecting? Let's start there.
Yeah, so I think the dots right now are showing a median for 4 25 basis point rate cuts in 2025. I think that's going to move to 3 25 basis point rate cuts in 2025. So those dots would migrate higher. Now, to your question about, should we take that literally? No, I wouldn't take it literally, and I don't think markets will take it literally. But remember, markets are already pricing only 2 rate cuts into 2025. So even if they move from 4 to 3, there's still more dovish than the market is. What the market is looking at is what's the direction of travel.
Yeah.
If they're revising those dots up, then that's some signaling that maybe they're going to slow the pace of cuts. But what we also know about this Fed is it's a data point dependent Fed, meaning that each individual monthly data point is mattering for their interest rate policy. unemployment rate standing just below 4.3%, technically rounds to 4.2% right now. If that moves up to 4.4% in December, and I think it probably will, then they're probably cutting in January.
If we go to 4.4%, we're moving into a very different gear on the economic landscape, perhaps a little bit different to what we presume. You know, to go from 4.2 to 4.4 really is an acceleration, isn't it?
Yeah, so the cycle high that we've been at is 4.3. So I think in that sense, the Fed can say, well, we haven't had this rapid deterioration in the labor market. That's what the
real question we should be asking about neutral rates.
Yeah, I think the real answer is we don't know, and we can't know in real time. So it's a useful theoretical concept when you're thinking about how monetary policy should proceed. You don't really know where that neutral rate is. What Chair Powell has said, and I kind of like this formulation, we'll know it by its works. And what he means by that is we'll watch the data and we'll let the data tell us whether this is an economy that needs more or less restriction. And what we're seeing right now is an unemployment rate that maybe slowly, but is moving higher. If not for a decrease in the participation rate, this is really important. If people hadn't dropped out of the labor force, we'd have an unemployment rate of 4.6% right now. If the unemployment rate was at 4.6%, I don't think there'd be any question about whether the Fed would be cutting not only at this meeting, but again in 100%. January. And that could just come down to a quirk of the data, that participation rate moving, or it could be something fundamental, people actually dropping out of the labor market. So where neutral is, I think the market expectations of that are shifting wildly around based on the data.
For me, the biggest supply side risk is the immigration regulation that is going to change. Whatever way you think about the unknown, there is going to be a significant change in the immigration policy in this country. And that is going to have a jolt in this labor market. Does that, you think, show up in 2025? Or is that a 2026 and onward problem, the supply side of this narrative?
Yeah, I think we know that the pace of immigration will slow. There already is some evidence that it has slowed. So that means a slower rate of labor force increase. And so then the question that you're asking is the job growth keeping up with labor force growth? Is it stronger than labor force growth? Is it less strong than labor force growth? If we look at the most recent payrolls readings, we're running a pace over the last 2 months, 140,000 a month. And you'd say 140,000 a month, that sounds fine. But remember, this data is overstated by 70,000 jobs per month. We know that from the benchmark revisions, 818,000 downward revisions over a year, so it's about 70,000 a month. If you make that adjustment, we're only running about 70,000 a month new jobs. So that means even if immigration slows, we don't have a problem with a undersupply of workers. We have a problem with an undersupply of jobs and undersupply of hiring.
So what kind of a slowdown is that? I mean, everybody else is talking about no landing, so soft landing, no landing. Certainly recession is not a word that anybody's using in regards to this economy. So what kind of an economy and growth rate is that narrative that you're saying in the jobs market?
This is exactly the problem with the narrative right now. More than half of the people in this country think we're in a recession right now.
Yes, so, and we were just saying that in the break, weren't we?
Yeah, so it's a very different story if you're kind of the median consumer in this economy, or you're a small and medium firm, right? You've been hit by higher labor costs. Your borrowing costs are still high. We talk about easy financial conditions because credit spreads are tight and equity valuations are high. If you don't issue equity, if you don't issue corporate bonds, which are most of the companies in this country, it doesn't matter for you. So I think it is a very different story if you're kind of in the middle of the economy versus the very higher end of the economy. And I think that is where the market has kind of lost the sense that things could be weaker than they look from the top line numbers.
Yeah, it just depends which part of society you're sitting in, whether you're sitting with a healthy 401k or perhaps in some other part of the economy which has had a real recession.
Exactly.
Andrew, thank you so much for being with us this morning. Let's see what the FOMC delivers and the guidance. That's Andrew Hollenhorst of Citi. Quick snapshot of the real. The dollar is almighty, but let's have a look across the asset board first of all. You've got stocks up 0.25%. Roll it over. I want to get straight to the real. This is the much more important concept for us to deal with today. We traded through a record low yesterday at pretty much down 21% on the year. You can see the dollar up again over the past 3 days. There's been massive intervention by the central bank, forceful intervention, and still it has had very, very limited impact. There is the move over the space of a week. Jeffries says this is a rout and it's a train wreck in terms of what's happening within the emerging market in Brazil. We'll keep you abreast of those market moves. Coming up, shutdown showdown. The lawmakers released the government funding bill ahead of Friday's shutdown deadline. We'll discuss that with our Washington reporter in just a moment on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
One of the very critical things is that a lot of young entrepreneurs don't realize is that when you start as an entrepreneur, you're not just building your business, which of course you are, but you're also building an organization. And most people don't realize that. And building an organization is not just about hiring people. It's about the culture, it's about the systems, the values, the mission. You know, it's about how you operate, how you do things, how you retain people, how you keep them motivated. So it's all of those things put together. And over time, you realize that, you know, a lot of effort has to go into it. And then eventually you have an organization that has a life of its own. It's, you know, and it's sometimes you look at it and you marvel and you think about, you know, how was this created? And was I the person that was behind getting this thing done?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Manny Scranny here in New York. The funding challenge continues on Capitol Hill. House Speaker Mike Johnson struggling to reach a deal to keep the U.S. government open beyond Friday after lawmakers released their short-term bill to avoid the shutdown. Meghan Crane joins me now. Meghan, I mean, this is a real test for Speaker Mike Johnson, isn't it? My favorite line was that they're stumbling into Christmas, literally, with lawmakers decorating the tree with all their pet projects. It's a brilliant line. It sort of encapsulates what is happening on Capitol Hill. What are the stumbling blocks and what are the heaviest gifts they want to hang on that tree?
Good morning. Yeah, so this is a Christmas tradition in Washington. It certainly has become one to try to fund the government right at the end of the year when everyone is trying to leave town. So the stumbling block here is basically that conservative Republicans on Capitol Hill are not interested in large funding bills. They want government trimmed significantly, and it's very difficult to agree on how to make that happen. So, you know, they have reached a deal to stretch government funding through the end of March, and it will very likely pass with help from Democrats. It's important to remember that that same calculus cost Kevin McCarthy his speakership just a year ago. It feels like forever ago, but it was actually just last year. Trying to fund the government through bipartisan cooperation. This bill includes some disaster funding that the Democrats wanted, and conservative Republicans are not happy about that. They really don't like these continuing resolutions. Interestingly, just about an hour ago or so, Elon Musk tweeted that the bill should not pass. I'm really curious how people are going to react to that on the Hill and whether Donald Trump reacts to that. Like I said, they still have Democratic support, so it will probably pass, but that could...
But then Megan, this really raises the question about the policy path forward for 2025, doesn't it? I mean, they're going to have a slim, razor-thin majority, and this is where, as Anne-Marie has said several times, and we've talked about it with you, everybody's a kingmaker. So this doesn't bode well for policy execution in 2025 with the Trump mandate the way that it is.
It doesn't, right? I mean, Donald Trump won convincingly, but Republicans did not win convincingly in the House. Until the end of March or even April, they will have a 1-vote margin, which is not much room to, to maneuver with for Speaker Johnson. And, he will have a very difficult path to continue to move things forward, and it will essentially be impossible to do without acting in a bipartisan way.
Indeed. And then we've got the Biden administration on the way out the door. They've been debating what they'll do with Chinese semiconductors and a probe into that for months. Why act now? They've already upped, on legacy semiconductors, they've already upped the tariffs. Why put this probe in place now? Is this one last swan song for the Trump administration to deal with?
That's a good question. I think, I'm not sure it's just handing it off to the Trump administration. I suppose it just maybe was time to do it, but they it is interesting that now it will land on Trump, right? This investigation into chips will become Trump's it will give Trump ammunition to sort of impose more tariffs on China, trade restrictions on China. And I think that'll just be really interesting to watch how that manifests, whether they sort of go along with the national security concerns about chips that the Biden administration has shown.
And let's just round off. We have the appointee for Ukraine for Donald Trump, president-elect. It's Keith Kellogg. Now, we understand he's going to be going to Kyiv, but there is a line in this reportage that he may be open to a visit to Moscow. That's going to be fascinating given the amount of sanctions that we have at the moment. So why do you think they're flying this kite about his potential to go to Moscow? What does it say about an expedited foreign policy resolution?
Right. So Donald Trump has been very clear that he wants an end to the war in Ukraine to come very quickly, and that he's willing to, really push Ukraine to make concessions to make that happen. And this is just another sign of that they are willing to make pretty bold moves to end that conflict in Ukraine, even if it means benefits to Moscow in the end.
Okay, Megan, thank you so much for being with us this morning. That's Megan Crane in Washington on the latest political stories. As we broke at the start of the show, U.S. graphite producers here in the United States, they're looking for sharp tariffs on Chinese graphite, arguing that the subsidies from Beijing make it impossible for them to compete. Now, a sharp tariff increase would raise the cost of U.S.-made EVs, threatening to raise the prices of the cars, which have already seen their subsidies at risk of being removed. President-elect Donald Trump certainly has intimated that, along with Elon Musk. What does it mean for Tesla, of course? Let's stay with the auto story, because across to Japan, we've got stocks in Nissan surging the most in 5 decades. Bloomberg has learned that the automaker has become the latest buyout target. Nissan's biggest shareholder, Renault, is seeing its shares rise after saying it would be open to the two companies pursuing merger talks. Let's get to Albertina Torsoli. She joins me now. Albertina, Honda and Nissan getting together. It's a big political gamble for Japan, and it's certainly Nissan does not have a strong hand in this negotiation. Putting the two of them together, what would we get?
I think that certainly Japan has a problem, having some weak players, a player that used to be very big like Nissan, it's a big problem. So I think that the problem they have at hand is trying to figure out how to have come up with an idea, a big player that can take on Toyota, but also other car makers in the world that are moving. Yeah. Of course, you have Chinese EV manufacturers, you have American players, you have a lot of movement right now, and you have a lot of challenges. And Nissan tried to, was keen on rebalancing the alliance with Renault, didn't want to be controlled by Renault. has its freedom back in many ways because, Renault is selling down those shares. The rebalancing deal will end up with a 15% stake only in Renault's hands. But of course, that freedom also comes with challenges and risks, right? And Renault is not willing to pay up for Nissan's problem anymore now that, the alliance has been partially unwound.
Yeah, well, I mean, Nissan's bleeding cash. It's got a $1.6 billion maturity wall next year. They need this deal. You talked about Renault there. Bid this morning, the sense is that this is a relief moment for Renault. As you say, they've been bailing out sort of in a whole variety of ways what's been happening at Nissan. It's a fairly tortured relationship between them, isn't it?
For sure. Yes, it's been tortured over the years. I think it's a bit too soon to talk about relief. I just think Renault is eager for Nissan to find ways to become stronger. And, when you own, to date, Renault still owns 36%. Part of it is in a trust, so kind of indirect, but part of it is still direct. If Nissan becoming stronger will go through a deal, a merger, a new partnership, well, why not, right? So I think that today the main point is that, yes, Renault as main shareholder will have to give a nod to anything that Nissan decides. If it wants to pursue one deal or another deal, Renault will have to say yes because it has a say on the matter. And they will have to see whatever deals or possible projects come up their way, and they will have a look and they will protect their interests. But of course, I think once again, the main point in making sure that Nissan, solves its issues, whatever way it is. And, the issues are big here. In early November, Nissan announced, slashed the profit forecast, said it would have to eliminate 9,000 jobs globally, announced a 20% global cut to global output. I mean, all of this will reflect also in Renault's numbers, right? If Nissan doesn't solve the problem. So I think that the framework of the new alliance between Renault, Nissan, and Mitsubishi is to support each other. And Renault will probably support Nissan if it finds a go way out of the crisis. I think that is very factually what we can say today.
Where do you think Hon Hai could fit into this? I mean, we understand that they have made an approach. Obviously you've got national champion interest at home in Japan, and then you have this other potential approach. Where does Hon Hai fit into this?
I think that a lot of parties must be looking at Nissan and seeing what's in for them. Can they play a part? Once again, how M&A is or how movements are. If there's a company perceived as weaker, then people start looking. And especially since talks with Honda and Nissan didn't start yesterday, they have been going on for quite a few months in different shape or form. Others are looking and others may be coming forward. Now is the time to move, right? Not when a Honda-Nissan deal is done, if a deal comes. So I think that it will be a period of turmoil for Nissan, a period of observation for Renault. And whoever wants to play their hand probably wants to do it sooner rather than later because the Japanese government will try to find a solution as quickly as possible.
Albertina, thank you very much. Great ups on Albertina Torsoli there on the Nissan potential deal.
countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Here's a look at the day ahead for you. U.S. housing starts and building permits, 8:30 a.m. But the main event of the day, it is the Fed announcing their rate decision at 2 p.m., followed by the Chair Powell's press conference. What will his tone, what will his intonation be? Micron reports their earnings after the market close. We'll run you through those in the morning. A couple of stocks to watch. Micron rising ahead of its earnings. The street to focus on the AI demand side of the equation. NVIDIA rising after entering that correction territory, snapping 4 days of declines. And then Citizens Financial raised to a strong buy by Raymond James. Obviously, we're keeping an eye on Tesla and Boeing as well.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
From the world of politics politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
We don't quite know what's happening in the U.S. economy, and that's something that other central banks are looking at.
The U.S. exceptionalism story, we think, still has some legs.
I think that America has still got a very good narrative.
There's just no interest for anything except the U.S.
For the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. Bloomberg Surveillance starts right now with equity futures on the S&P 500 just about positive by 1/3 of 1%. It all comes down to this. The final Fed decision of 2024 at 2 p.m. Eastern Time. We'll get a Fed decision widely expected to be an interest rate cut. 30 minutes after that, Bramo, we'll hear from Chairman Powell.
And does he sound dovish the way he has many times before? This, to me, raises a really key question, and you and I have been debating this extensively. What will the market's response be to a Fed chair that comes out more dovish versus one that tries to stay the course and actually re-emphasizes the threat of stickier inflation? It's not so clear-cut that the market will embrace just outright dovishness.
Where it is clear-cut, where there is some consensus, they cut today and they skip tomorrow. That's what a lot of people seem to think coming on this show.
Torsten Slok last night was on Bloomberg, and he was talking about the fact that regardless of what happens, even if they cut, rates will be higher for longer. And he says all of this has to do with policies potentially next year. What happens when you are cutting into a reacceleration maybe of the economy because of policies in Washington like tariffs and like tax cuts?
So this was described as a recalibration phase. This will be 100 basis points of cuts across 3 meetings. Feels like we're going into something else with a different cadence. I wonder how you describe it, but it certainly looks like this Fed chair is looking to get some optionality into a very uncertain 2025.
And the market's giving to him. And that's basically what I think is really interesting. How is he going to embrace it while not seeming like he's simply following whatever the market gives him? I thought it was fascinating. Jim Reid over at Deutsche Bank had this note, and I really thought it was insightful, that this is the 3rd year in a row that markets have overestimated just how dovish this Fed would be in terms of how many rate cuts there would be. To me, basically, and as Julian Emanuel pointed out, stocks haven't cared. So you have higher rates, you have equities that keep pounding out returns, and it raises the question of where the market's saying this is stickier inflation and not that restrictive of a rate.
Andrew Hollenhorst, though, was just on, and he was saying how, given the fact that this Fed is so data point dependent, if they see any uptick in the unemployment rate, potentially then you could see a cut in January.
Do you want stat of the morning? Every single Fed meeting so far this year, with the exception of September, the 2-year has rallied. Yields have dropped at the front end. Chairman Powell, we talked about this a few times. He likes this one gear, and that one gear is dovish. Will later this afternoon be any different?
Good question. I think if you look at WikiLeaks, or if you look at one particular person over at the Wall Street Journal, it's talking about, the potential for this Fed chair.
Such a hard time.
Well, okay, I think it's wonderful. We're all jealous of you. I think it's great. You are the earpiece of the Federal Reserve. It just raises a question. He had to talk about how the 50 basis point rate cut came at the basically the cajoling of other members saying we will be much more moderate later on. Does he really pivot in a way to acquiesce to them, or is there basically the same kind of dovish tone?
He being Powell and not WikiLeaks, of course. In the bond market this morning, yields unchanged on a 2-year, unchanged on a 10-year. We traded about 440 on a 10-year maturity. Coming up this hour, we'll catch up with Julian Emanuel of Evercore, looking for the S&P 500 to hit 6,800. We'll catch up with Elias Galou of Bank of America on a super bullish global fund manager survey, and we'll speak to Veronica Clark of Citi, looking for the Fed to keep cutting interest rates. We begin this hour with stocks rising as traders await the final Fed rate decision of 2024. Julian Emanuel of Evercore optimistic heading into 2025. A combination of the long-lasting after effects of pandemic-era stimulus and the AI revolution will support the S&P 500 to 6,800. Julian joins us now for more. Julian, good morning.
Good morning.
What happens at 2 p.m. Eastern Time this afternoon?
Well, we're going to get a 25 basis point cut. We know that. Our central bank's policy team thinks there's going to be 3 more next year.
But the question is the messaging of it. Look, as Lisa pointed out moments ago, the market has been very good at reducing the number of expected cuts, and it hasn't really mattered. And, you know, to us, north or south of call it 3 out to next December is probably the right way to think about it, you know, in terms of the handicap. But the question is what's the message on how things evolve given the potential for inflation to be sticky in here?
Whatever happens, you're bullish into next year, 6,800. Not as bullish as some on the street, north of 7K. We've heard that from the likes of Wells Fargo, from Deutsche Bank, from John Stolfus over at Oppenheimer as well. Bank of America put out a note yesterday. We can stay in a bubble longer than you can stay underweight. Are things frothy into 25?
There are certainly parts of the market that are very frothy. Crypto, anything is incredibly frothy, that we know. You know, other aspects of the quote-unquote Trump trade certainly are frothy. But we think about it more as, you think about the first quarter of 2021, right, where you had lots of froth in the meme stocks, in SPACs, in profitless tech, and they really crested in that period, but it did nothing for the cadence of the overall market. The overall market kept right on going, and for us, close to 10% earnings growth next year is the thing that can continue to propel stocks higher.
Just to combine John's two questions, he starts by asking about the Fed and what they're going to do, and then the bullishness, the fact that stocks haven't cared. At what point is there a connection between what the Fed does and the reaction by stocks? In other words, if they cut, at what point does that give an extra boost to stocks? And if they don't cut or even raise rates, at what point does that torpedo some of the gains that we've been seeing?
So in our mind, it is really a function of the 10-year yield. And remember, let's go back to September when you had the initial 50 basis point cut. The surprise to a lot of people was that yields on both the long end and the short end rose as briskly as they did. Well, the only other time that actually happened at the start of a cut cycle was 1995, the virtuous only real soft landing, ostensibly till the one we have now. But from our point of view, it's not just where policy goes at the Fed, but where policy goes in the White House, based on where the bond yield goes. Over 4.5%, there'll be questions. Over 5%, which is not our base case, is where markets and assets generally and policy runs into the headwinds.
Are we getting a small taste, a preview of which stocks do best if yields inflect upward a bit? In other words, we saw this sort of lack of broadening out, this isolation in the Magnificent Seven and big tech over the past couple of weeks. We've seen the longest run of more decliners than advancers in the S&P 500 in more than 100 years. We've seen 12 straight days of that. Is that what we can expect going forward if yields don't materially come down?
That to us is perhaps as much of a seasonal bias as anything else. There's a tendency, particularly when you've got animal spirits rekindled on the part of the investing public, which clearly we have had post the election. They tend to want to press the winners into year end, and obviously we've known what the winners are. In fact, that actually tends to reverse in January, so we wouldn't be surprised if there was a bit more of market volatility as those winners pause. Doesn't say much about the rest of the year because we think those names will lead the rest of the year, but it does say that if we get into this environment where speculation grows ever more, that those are the names that could get you into what we would consider potentially overvalued territory.
Well, we see a lot of speculation about policy, and you were just mentioning the fact that maybe at 5% on a 10-year yield, that would start to get the market nervous. Is that the third rail, maybe, potentially, for this White House?
No question. No question. And the market told you what it thinks when the appointment of Scott Bessent caused bond yields to fall, you know, very materially over the next several weeks. And that was, you know, balm for the post-election rally. And we think that, you know, with someone like Bessent at Treasury, attention will absolutely be paid. Because remember, if you go back and you think about 2018, the mistake is that policy got muddled with the fact that inflation was stickier, but the real thing, and caused the fourth quarter of 2018 sell-off, was that the long end bond yields started rising too much uncomfortably.
If that's the ultimate check on policies, what do you think the policies are going to be?
Well, we know the intent is to promulgate tariffs. We know that the other key will be tax policy extending the original cuts from 2017-18. And of course, immigration, and in aggregate, most of the financial modeling, and I'm sure most of the people that you talk to say, A, they're inflationary on balance, B, they expand the deficit, and C, they may not necessarily be as pro-growth as expected. But as was the case in 2018, we have to see how they get implemented.
It's potentially a bigger problem for the rest of the world. And we've seen that story play on repeat over the last few weeks. Take the data of this week, Lisa. If you look at the retail sales of yesterday, pretty strong. The services PMI the day before, pretty strong. You compare that to what we saw in Germany. Business confidence, rock bottom, terrible. Retail sales, consumption numbers out of China, awful compared to expectations. Just not good relative to the rest of the world. The rest of the world is really struggling.
And we've seen this isolation, and I think that that's really one of the key questions for 2025. How far can that divergence go between the U.S. and everybody else when it comes to rate differentials, when it comes to the currency, and when it comes to just economic growth with the U.S. driving the rest of the world?
Julian's going to stick with us, so we'll have some time to talk about the rest of the world. But my chart of the year for 2024, the Chinese 10-year yield, falling. And falling rapidly, and then some. That is a very different world compared to the one we're talking about in the United States.
Yeah, record low now for their yields. Do you have a book of the year too? Are you going to have a book of the year every 2 months?
I leave that to TK.
Are you going to
I leave that to TK.
But he tends to have a book of the year every 2 months or 1 month.
Book of the summer.
The book of the summer.
It's like the book of the season. I'm not sure what the book of the summer was. Do you know what it was?
Yeah, I have no idea. It changes. It changes depending on the week.
We'll find out. We'll find out later on the Fed show. Look out for that a little bit later. TK will bring his book of winter and spring of 2025 ahead of time for you a little bit later, so look out for special programming. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. President Joe Biden expressing support for a stock trading ban in Congress. In an interview with More Perfect Union, Biden said nobody should be able to make money in the stock market while they're in Congress. It's unclear what impact the comments will have, as several previous attempts to ban stock trading by lawmakers have failed. Meanwhile, Boeing is resuming full jet production in the Seattle area after shutting down for weeks due to a lengthy workers' strike. According to the head of its commercial jet division, Boeing has now begun building the larger 767 and 777 aircraft again. The company cautioning getting production back to speed will take time, though, because some workers need to be recertified and components may be out of position. And the two NASA astronauts who've been stuck in space since September will have to be there longer. According to NASA, their mission has been extended again, and the pair will now return in late March or early April because of a delay in launching their replacements. The two test pilots planned on being away for 8 days when they blasted off in June, but multiple issues with Boeing Starliner prompted NASA to leave them behind at their International Space Station. That's your Bloomberg Brief. John?
Yahara, thank you. How isn't this on the news every single day? You go up in space in the summer, you expect to be there for 8 days, and it could be pushing 12 months.
I want to send them cards. Can we send them board games? If you know of someone that we can send, board games, candy, just something.
How are you sending them cards? What are you talking about?
I don't know. What do they do all that time?
About?
It's Wednesday.
All right. Up next on the program, sky-high investor sentiment.
Sentiment's very positive. If I had to summarize it, people are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
It's like Elon Musk turning into Royal Mail. Like, what's going on here?
Well, I feel bad for them. What do they do with all their time? Do they just sit there and stare at the moon?
It's a long day ahead of us from New York City this morning. Good morning.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
The Fed decision later on this afternoon. The S&P 500 struggling to string together 2 days of gains on the S&P. Negative breadth every single day through the month of December so far. Equities this morning up by 1/3 of 1%. In the bond market, just about unchanged. Your 10-year yield, 440.27. And the surveillance this morning, sky high investor sentiment.
Sentiment is very positive, but I think sentiment is positive for a reason. You know, the economic growth has been surprising to the upside. There is a view that the deregulatory and tax impulses from the Trump administration are going to be positive. If I had to summarize it, people are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
So here's the latest this morning. Bank of America's latest global fund manager survey finding sentiment is super bullish, showing cash allocation at a record low, with U.S. stock exposure at an all-time high. The team writing the December jump in global macro sentiment was led by greater optimism on U.S. growth, with the highest percentage of fund manager survey investors expecting a stronger U.S. economy since at least November 2021. Joining us now is Elias Galut of Bank of America. Elias, I want to come to you on those 2 points. Record low cash allocation, record high allocation to U.S. equity markets. From the standpoint of you and the team, is it time to think about leaning in the other direction?
Hi, John. Great to be here. Look, I mean, historically, these moments of extreme positioning, because that's the bottom line of this month fund manager survey, that positioning is extreme at the moment. It's all about the U.S. Everyone is long the theme of U.S. exceptionalism, and historically, this kind of extreme positioning has often been followed by turning point in the market. There are also orange signals that have been flashed by this survey. If you particularly look at the cash allocation, it dropped below a certain key level. Historically, it meant that risk assets are either facing the top or experiencing a sell-off. And more importantly, when you look at one particular metric that really stood out this month is the fact that investors are running a record underweight in terms of their positioning regarding cash, and that historically has coincided with big top in risk assets in the past 25 years.
Elias, a big top potentially for U.S. assets, or more broadly, given the fact that the overweight is securely in the U.S. and not necessarily overseas in Europe?
You're absolutely right. As you guys just said, there is a record high allocation to U.S., and the allocation to U.S. is even more striking when you compare it to the rest of the world. The FMS investors are the most overweight U.S. versus EM or Eurozone equities since June 2012. So here as well, there is extreme positioning. We think more that the overshoot that's probably going to happen in the first quarter of next year, it will still favor U.S. assets, equities and the dollar in particular. But then at the time in Q1, it will be a good opportunity to shift in favor of international assets, where positioning is way more favorable and also valuations are much more favorable than the US.
Elias, I don't want to say these words because I'm going to get pilloried, but is this time different? Have you found in your final survey of this year that some of the sentiment indicators haven't had the same kind of read-through in future market performance as they have in the past, just because this is a unique time with unique and fundamental structural divergences?
Look, absolutely. I mean, this time is different in terms of the fact that we have never seen, for instance, the behemoth of the Magnificent Seven group of stocks in history. I mean, when we ask investors about the most crowded trade, for 21 months in a row, they've been saying that long Magnificent stocks is the most crowded trade. And the fact that US also look very exceptional is also because the rest of the world looks very unexceptional. There's a lot of concern regarding growth opportunities in the rest of the world. So this time is different because the divergence that we see has never existed in the past. But historically, when we go back to the surveys, the kind of tops and extremes that we see in positioning, the fact that cash allocation is low, the fact that cash levels are also low, has often coincided with a turning point, and we are cognizant of that.
Where are the contrarians going, even though I know there's very few of them?
Who are the contrarians today? I mean, if those who believe there will be a Q1 overshoot just because growth will surprise to the upside, particularly in the US, those contrarians should be looking at international assets, at commodities as well. The allocation to commodities just dropped to the lowest level since June 2017. So international assets, Europe, commodities, these would offer the best opportunities. But the true contrarian entering 2025 are those who think that economic growth will be surprising on the downside, those who still believe a hard landing is possible, and those should opt in favor of cash and bonds, really.
As you're saying that, Elias, Lisa's sitting there nodding her head.
Okay.
Just nodding her head.
No, I
it's
saw
almost
that too.
instinctive. It was
No,
just
I
like
saw that
reflexive.
too.
Well, he's like, hold on a second. That's not true. I was just thinking that really is contrarian right now, to think about a downturn. And then I was thinking about Andrew Hollenhorst.
Oh, yeah.
Was that it? Or was she thinking, he's describing me?
I think Brower was just scared by the fact she said this time might be different, and then was like, no, bad growth, bad growth. Elias, thank you. Julian Emmanuel still with us around the table. Julian, good to see you. I want to talk about what Elias was talking about, the international backdrop, and the question that Anne-Marie asked. The most contrarian trade right now surely has to be to buy the rest of the world.
No question about it, and we are getting a lot of questions about it. But look, if you think about the last decade, valuation alone, the disparity was not the proper catalyst to own the rest of the world versus the U.S. or versus the Mag 7. And we don't think that's the case yet. What we want to see are a couple of macro turning points, most especially a peak in the dollar. We are at all-time levels. And we've seen, the Brazilian currency in the headlines yesterday, really all of these currencies. And when you think about it, recall back to the first Trump administration, there was a time when President Trump became uncomfortable with the strong dollar.
True.
So if we get messaging like that at some point, if in fact the economy maybe shifts lower for some unexpected reason, that's when we think the move towards the rest of the world. Then the other thing, and you pointed this out earlier, is that particularly with regard to China and the message it sends the rest of the world, yes, we understand they're trying to reflate, but the bond market is telling you it is not successful at this point.
What is going wrong in China right now? What does that chart that we talked about, that chart of Chinese bond yields just rolling over aggressively, what does that scream? What does that tell you?
It really reflects to the fact that the dynamics around the property market are very complex and are likely a longer-term workout than, any short-term stimulus patch.
To go to that point, there is this feeling, and Elias Galou is talking about how one of the contrarian ideas is a downside shift to growth. How much is that only in the United States, and does that coincide with a top in the dollar? And I ask this because we certainly aren't seeing a downside to growth in China, as evidenced by the yield chart. We're seeing a downshift in Europe. So how much is that kind of what has to happen to send the dollar lower and to reverse a lot of the trades?
Well, that would be sort of the likeliest series of events. But I would also say that, if you think about things geopolitically, if you were to see a greater semblance of calm, either on the Ukraine-Russia front or in the Middle East, that could be the catalyst for the lower dollar, and that could actually be the catalyst for more confidence in a higher potential growth trajectory in Europe. So that's the virtuous case, and it's certainly possible.
Foreign exchange is a relative game. It's a relative story, and we've asked the question on repeat over the last few weeks, how little needs to go right in Europe to get this trade to go in the other direction, given how depressed expectations already are.
We've been talking about that. I've been waiting for some upside surprises.
You've been looking for some good news?
Yeah. It's been a little rough, you know? Lowest business confidence going back to what, 2020? I saw that and I'm thinking, all right, I think you just need to kick the bar up a little bit higher.
Still my favorite question at the moment, though, for the end-of-year quiz. I talked about this with you in the green room. Ask someone where they think the DAX is year-to-date. The DAX year-to-date is up by more than 21%. Which is amazing. That's the benchmark in Germany, up 21%.
I need to take notes because I'll know what your year-end question is, I'll know what your year-end chart is, and I'll be able to ace the quiz at the end of the year.
Book of the year, we'll get that a little bit later. Special programming, the Fed decides, Bloomberg Surveillance Special, we get TK's Book of the Year.
Book of the summer, Book of the winter, Book of the spring.
Looking forward to that. What time does that start, 1:30?
That starts at 1:30, yes,
1:32?
Yes.
1:32, so precise around here, aren't we?
I mean,
1:32 Eastern
that's
time.
what your mind thinks too, don't even lie, come
Julian,
on.
it's good to see you.
Good to see you.
Thank you, sir. Thanks. Julian Emmanuel there of Evercore. Up next on the program, we'll catch up with PG&E CEO Paddy Poppe on the Biden administration's $15 billion loan offer.
Is the Vivian Tom clientele? Yeah, power women, like the dragon, dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Average price target on the S&P 500 into year-end next year, 6,600. The high, 7,100. The low, 6K. Very bullish going into next year compared to where we were last year looking at 12 months when the average, and I've got it in front of me, Lisa, the average for this year, year-end, 48.33 on the S&P 500 12 months ago, looking at 12 months.
So what did people get wrong? Two things. One, they got wrong how this market would respond, equity market would respond to higher yields. They didn't get wrong just how low yields would go. In fact, they expected them to be even lower. And two, they underestimated how long the Magnificent Seven could remain leadership, because ultimately they have continued to power returns even amid a couple brief signs of broadening out.
And to some extent, they've been conditioned by that, looking out to 2025. So equity futures right now up by about 0.25%, on the NASDAQ up by something like a third. In the bond market, going into that Federal Reserve decision on a 2-year, a 10-year and 30-year, we shape up as follows. Yields just about unchanged on a 10-year maturity at 440.27. At the front end of the curve on a 2-year at about 425. I was comparing where we are now to where we were the last time we had a Fed decision. At the last meeting on November 7th, the close on 10s, 432.57, on 2s, 420. So we haven't moved too much since the last meeting.
No, but to the extent that we have, it's been up. It's been the market ratcheting up expectations for longer-term neutral rates and really kind of throwing a question for the Fed, just how restrictive are we? And really, how much further are we from neutral, given the fact that this market seems to be showing no signs of falling off the grid?
As those yields have stayed elevated, it's fueled that US dollar trade, the dollar a whole lot stronger. We've repeated this stat over the last week or so. We've only had one down week for the DXY dollar index for the fourth quarter so far. Euro dollar clinging, and I think that's the right word, clinging to 105.
So it raises this question, when do we get to that peak dollar? We talked to Julian Emmanuel, and he said that would really be the tipping point, at which point you could start to invest internationally. How far do we have to go there before it becomes a problem for other countries, as well as for the United States, where you have a Trump administration that wants to increase exports at a time where they're getting increasingly expensive for countries around the world?
The news is just bad elsewhere. Look at Brazil. Julian talked about it. We're talking about 6 against the US dollar. Down in Brazil, in Canada, talking about levels we haven't seen since 2020. It's not just Europe, it's everybody else.
And it raises, though, again, why isn't the dollar stronger? If the dollar gets stronger, does that become a problem in terms of rearranging things? But you're right. There's no reason not to lean into the dollar right now, because who are you going to get excited about? I mean, honestly, are you going to get excited about Germany? Are you going to get excited about Canada? They're having, what was it? A friendly holiday spat?
Did you see the come by our moment?
A festive holiday
to his
fight.
party? Yeah, we'll talk about this a little bit later. DXY pushing 107. Under surveillance this morning, lawmakers unveiling a bill to extend government funding into March, infighting among House Republicans over attaching funds to agriculture, disaster, and other priorities, threatening to take Congress right up to Friday's midnight deadline. I believe Elon Musk pushing back against this bill as well, right?
Yep, he's saying this bill should not pass, and then he posted a photo of the mammoth bill and said, ever seen a bigger piece of pork? Also in this bill, this Christmas tree, if you call it, because everyone's throwing an ornament on it at the end of the year. This is something Speaker Johnson wanted to avoid, and actually was the downfall for former Speaker Kevin McCarthy, would also give lawmakers a pay rise. This is going to be very controversial within the Republican Party, so they're going to need Democrats to get this over the finish line in the House.
My favorite is people talk about these highfalutin goals, these good policies, and then we come down to it. It's, you know, can we pass a budget? I don't know. Can we throw a couple more things in it? It just gives you a sense of how quickly this government can move.
My favorite, and the reason people really dislike politicians, there are many, but here's one.
People.
An individual that has been in Washington, D.C. for decades. Decades. How many decades? 4, 5? I'm talking about the president here.
Talking about Biden, yeah.
Okay. On his way out, on the last few months in Washington, D.C., decides that they shouldn't be able to trade stocks in Congress. Where's he been?
Well, I personally think this might be personal for him.
You think it's about Pelosi?
I do think this might be about Nancy Pelosi. I don't think the two have spoken since she, threw him under their bus. pretty much, and basically pushed him aside and said, it's time for you to step down. You need to pass the baton on. Of course, I'm talking about in the summer when he then passed the baton to Kamala Harris, and then she lost. And there's been a lot of speculation about the fact that her husband is an investor. And I think maybe this is directed towards her.
This feels like when you leave high school and you tell everybody what you really think in the yearbook. That's all. I'll leave that there.
Did that happen in high school? That from experience?
I'm just saying.
Let's get these little tidbits from Lisa.
Let's just move on.
About what childhood was really like. Let's move on to this. The Biden administration set to open a trade investigation. I want to read that. Into Chinese semiconductors. Sources telling Bloomberg the probe could result in tariffs or other measures to restrict imports on older model semiconductors and the products containing them. That includes medical devices, cars, smartphones, and weaponry.
So they've been debating this for months, and kudos to Jenny Leonard and Josh Wingrove for scooping this, whether to initiate this investigation under 301 under USTR. What the interesting aspect of this, if they were to go ahead with this probe, the Trump administration needs to pick it up. But I really see no daylight when it comes to China and when it comes to semiconductors, and I think they would be happy to pick up this investigation.
That's the latest down in Washington, D.C. I wanted to squeeze in this story as well. Nissan in talks with Honda about a possible merger, a deal that would create the world's third largest automaker. Sources telling Bloomberg discussions have accelerated after Foxconn approached Nissan about taking a stake. Bloomberg's Craig Trudell joins us now for more. Craig, talk to us about why this is happening and why this is happening right now.
I think, in short, it's a matter of sort of disaster and trying to avert it in the case of Nissan. Honda has been sort of reluctant to do something like this. There's been talks for months about these companies potentially working together, but on a smaller scale, sort of select projects, maybe some cross shareholding, but not an out-and-out merger. And I think, we know that years ago when Carlos Ghosn was sort of unceremoniously pushed out at Nissan, Japan's government was very concerned about the long-term future of the company, and those concerns have only been, sort of realized. And they saw in Honda a potential sort of savior in terms of a fellow Japanese partner who could help them weather crisis. And what we've seen just in the last few years since then is, a company that's gone from crisis to crisis that really has not been able to get out of its own way.
It's looking more and more like a distressed asset as the days go by. Craig, we'll spend some more time with you before year-end to talk about this. An update there from Craig Trudell out of London. Elsewhere, the Biden administration offering PG&E a loan of up to $15 billion for projects including upgraded hydropower generation, battery storage, and transmission lines. The Energy Department saying it will help the California company meet increasing demand and lower consumer electricity bills. The PG&E CEO, Patty Poppe, joins us now for more. Patty, it's good to see you.
Good morning, John. Nice to be with you.
How close are we to closing a deal?
Well, we have conditional commitment. That was big news yesterday. A couple of weeks, we think within the next couple of weeks, we could finish and close the deal.
How transformational would it be? What would this enable you to do?
This enables us to save money for customers. This is a straight pass-through to all of our customers in PG&E's service area. We could, over the life of the loans, we would save over $1 billion for customers. It's a replacement for other traditional debt financing, and it's just a lower interest rate fundamentally, and so up to about $100 million a year in annual rate savings for customers. Listen, when electricity is essential to powering the growth of California, we need to make sure that it's affordable.
It raises a question, especially as we have a number of private capital infrastructure heads come on our show and talk about how much interest there is from the private sector to finance some of these projects, and that the future ahead really is these sort of private-public partnerships. I'm just wondering how much you're thinking about where you're going to want public financing and where you see private financing for coming in.
Well, I think it's a pretty standard mix. We just did a big equity issuance a week ago. We completed all of our equity funding for our 5-year, $63 billion program. So we did a $3 billion equity raise last week. We combined that then with traditional debt, just traditionally. In this case, this actually just acts as financing. There's no role for the government in the projects themselves. We do the work. Our labor, our workforce, they deliver the benefits to customers, and we just get it at a lower cost.
How urgent is it to really build up the capacity to produce power right now? We talked to everyone about some of the data plants and how much energy they require, in addition to extra cooling and a whole host of other necessities. How instrumental is it for there to be additional capacity in order to prevent prices from becoming astronomical?
Yeah, I actually see the opposite impact. We call it net beneficial large load. This is a great opportunity for the industry to add new customers, new use for our product. We have an underutilized grid. In my service area alone, our grid is utilized about 45%. So all this new demand from electric vehicles, building electrification, and data centers and AI and large load can be net beneficial for customers. We see an additional gigawatt of data center load can reduce customers' bills 1 to 2%. Add another million EVs, bills can go down 2 to 4%. We see new electric uses as the first time in decades that we can actually see load growth that lowers the cost of energy for everyone, fully utilizing assets, reducing the costs.
This loan is coming at an interesting time, though. One, it needs to be finalized before new administration comes in. Do you think you'll get it done before January 20th? We're some 30 days out. And if not, do you think this could happen under a Trump energy department?
Well, number one, we're optimistic. We've been working hard with the DOE to get this done for months. It's culminating now. I do think the Trump administration shares our value of the importance of the grid and powering the onshoring in America, powering new data center, remaining the global leader in AI will require power. So having a better grid is going to be good for everyone, and we think the Trump administration will see the value of that too.
Has there been communication with members of the transition team and your company?
Yeah, we haven't been talking to them. We're focused on finishing the year strong and really making sure that we deliver for customers here as we wrap up the year.
For 2025, what kinds of changes are you expecting, whether it's just with the regulatory framework or just the desire to do some of the things that you're talking about to broaden out the efficiency of the grid? Do you see some structural changes to the approach that companies and the government have?
I do think we're going to have to get faster at permitting. Permitting reform, I think, could be a big agenda going forward. We're excited about building new infrastructure that lowers customers' bills, and so we need to make sure that we can do that safely and environmentally sound, but do it quickly. And the faster we can move, the faster we can power really a growth era for our company. We see ourselves as very much a growth utility. We have created real visibility to both our dividend. We're going to maintain a lower dividend than the sector as a driver for creating investment capacity. And so we can build out this infrastructure to best serve the people of California. And I think it serves as a model. We have a really exciting project in San Jose where we're demonstrating new housing units being built, 4,500 new housing units. Housing is in shortage in California. 4,500 new housing units, all electric, with 3 data centers in downtown San Jose that are net beneficial with heat capture to help offset the cost of that electric usage in San Jose. It's going to be a net zero city, and we're pretty excited about what that means for the people that we serve.
You talk about trying to diversify our use case for your grid, including electrification and including basically recharging cars, like Tesla charging stations. How concerned are you about the tiff between California and Tesla and Elon Musk and some of the build out in California as a result?
Look, I don't have a tiff with Elon Musk. He has built a great company. We're working closely with him and his company. They've been a great customer of ours. And in fact, together we have implemented some new, what we call distributed energy resource management tools, so we can build out their infrastructure faster. Tesla wanted a 3.8 megawatt charger station. And by our traditional methods, we told them you can have that in 4 years. Like, that we were so slow. And then we realized, actually, with the right tools and right dynamic load management, we could get them that capacity that day. So we've changed the way we serve customers. Tesla's made us a better operator, for sure.
Would you like to be our resident UFO expert this morning?
We are a big drone operator.
I know you are. Tell us what we need to know. Do we need to get used to this?
Look, drones have really important rules and standards within which we operate. We have a huge drone fleet. We use them to monitor and inspect our assets. We were one of the first utilities to get outside of line of sight operating rules and access. So in fact, we can have an operator in a command center operating a drone 200 miles away, monitoring and managing our lines. We've increased our inspections by 600% as a result of the use of drones. I'm not flying them over New Jersey in case anybody's wondering.
Someone might want to know.
I love it.
Bedminster in mind.
Yeah, we're not that far, but we use drones very actively and safely to make sure that we're monitoring the best use of our equipment.
Patty, it's good to see you.
Great to be with you
Appreciate your time.
guys.
Enjoy the holidays. Thanks for being with us. Patty Poppy there, the PG&E CEO. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. Say Yahara.
Hi, John. Luigi Mangione was indicted in New York on first-degree murder charges in the shooting death of United Health executive Brian Thompson. Prosecutors say the shooting was a premeditated act of terrorism. If convicted, the 26-year-old would face life in prison without parole. Mangione is currently being held in a Pennsylvania state prison, though the Manhattan District Attorney said Mangione may drop his objection to extradition and could be returned to New York by the end of the week. And on those drones, the Pentagon has denied involvement in the drone sightings over the northeast of the U.S. The Defense Department said none of the drones are being flown by the Pentagon or are part of secret government tests, as conspiracy theories have emerged online. President Joe Biden also commenting last night, saying, quote, "We are following this closely. So far, no sense of danger." And Elon Musk is considering giving up to $100 million to Nigel Farage, the leader of the populist Reform UK party. After the two met at Trump's Mar-a-Lago resort on Monday, Farage wrote in the Telegraph that he's in, quote, ongoing negotiations with Musk about the donation, which would be the largest ever to a UK political party. A significant donation from Musk could boost Reform's chances in upcoming elections. That's your Bloomberg Brief. John?
Yahara, thank you. Amazing shift in British politics. Up next on the program, the final Fed decision of 2025.
Powell, who always likes to surprise us, he may have another surprise in store for 24, and that is, I think the market's gotten a little bit too concerned and hawkish about inflation. I think you may see a Powell that's a little bit more dovish than what the market's expecting.
I'm already skipping a year. The final Fed decision of 2024. I'm looking forward to the final decision of 2025 as well.
It's setting us up for 2025.
There we go. Thank you, AMH. From a beautiful New York City this morning. Good morning.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Two weeks left of 2024. Equity futures right now on the S&P 500 pushing higher by close to 1/3 of 1%. Bond yield stable. Going into that Fed decision, the 10-year 440.27. Under surveillance this morning, the final Fed decision of 2024.
Powell, who always likes to surprise us, he may have another surprise in store for 24, and that is I think the market's gotten a little bit too concerned and hawkish about inflation. I think you may see a Powell that's a little bit more dovish than what the market's expecting. What you may see him do is deliver the cut in December and then talk about how their rhetoric is really about a reduction in pace, not in a reduction in direction.
So here's the latest this morning. Investors are awaiting the Fed's final rate decision of the year. Traders widely expecting a third straight interest rate cut. Citi writing the following: softer jobs and inflation readings for November have not changed the market narrative that resilient activity and sticky inflation will allow only shallow rate cuts. Chair Powell may sound dovish relative to this consensus. Citi's Veronica Clark joins us now for more. Veronica, it's good to see you.
Good to be here.
I'm pleased you framed it this way because I think it's really important on any Fed decision day. When people come on the program and say, I expect Chairman Powell to be hawkish, I always think, well, hawkish relative to what? Relative to the last dot plot, maybe. Relative to market pricing for 2025, that's a higher bar.
Yeah.
Is that how you think about things too?
Yeah, absolutely. I think the market has set a really high bar for how hawkish Powell can sound, and he can easily underdeliver on that. I do think that we've had some data in the last couple of weeks that is going to give the Fed more confidence that the labor market is slowing, inflation is easing, and I think they will see that dynamic as evidence that rates are restrictive and they don't need to be, and you can take rates lower.
It seems like you have simpatico with Chair Powell's view of the world, which might be a bit more negative in terms of the economic growth trajectory than at least market consensus. And I take a look at some of the recent data that people talk about as showing resilience, and you point to all the holes, all the reasons why you can interpret it negatively.
Yeah.
What do you think the market's getting so wrong?
Yeah, I mean, I do think Powell maybe shares our more dovish, sentiment. For us, it really comes down to what we're seeing in the labor market. We do see, and I think everyone agrees on this, very low hiring, low quit rates, very low churn, still low layoffs. And I think most people will look at that and say this is a normalization after, tight labor markets of the last couple of years. The issue is that kind of labor market would look indistinguishable from how labor markets look before recessions, before you get that nonlinearity, you get to the layoffs and the unemployment rate rises much more sharply. Until hiring picks up, I still see that as a very clear risk.
Okay, I don't know what's wrong with me this morning, but is this time different in the sense that essentially
The second time
not
this
even
morning.
7 a.m. Hold on a second. Let's just be honest. People are talking about a new investment cycle. People are talking about an AI revolution. People are talking about lower regulations and lower taxes. Doesn't that set up a very different landscape than, say, one that fosters mass layoffs?
Yeah, no, absolutely. And we'll see if there are the animal spirits post-election. Unfortunately, I think there is just still a lot of uncertainty around what to expect next year. And if this has been a labor market that's been weakening for a while, I don't really see that changing in the next couple months at least. I mean, we have been running 2 to 3% GDP growth for over a year. Financial conditions are pretty easy, new highs in equities every day, and still the unemployment rate has risen by almost a percentage point. So what happens if that dynamic changes?
Well, what happens happens if we get stricter immigration policy from the incoming Trump administration? How tighter could this labor market actually move?
Yeah, I mean, that probably would be net inflationary, to the extent that we have had some strong immigration, of course, the last couple of years. That has probably helped to loosen the labor market some, bring wages, down. I think the issue is that we're really not going to get a whole lot of clarity or action on any of those policies until maybe late 2025. So for the
late 2025?
I would think so. I mean, until we actually see, actions, it will take, legislation and things like that. So I don't know if we're going to get, in the data, the impact of a lot of these policies.
Out of all these policies circulating and speculation, what Trump has said, there will be executive orders almost immediately, but maybe the impact we won't see. What are you most nervous about?
I'm maybe, in terms of new policies to expect, I'm maybe most nervous about if we do get some big cuts to government spending. We'll see, if that does improve efficiencies. Maybe you don't get the big hit to growth. But we already do have a little bit of a fiscal drop-off in the next couple of years. We had the CHIPS Act, the Inflation Reduction Act, infrastructure. A lot of that spending was front-loaded, for 2023, 2024. So it is already slowing for 2025. That could be a bigger fiscal cliff if you get big cuts.
Can I answer that question? Lisa on the edge of bullish is what I'm most nervous about.
Yeah, it's a little scary.
Okay, hold on a second.
I don't recognize her.
There is a narrative out there that there has been a complete shift in the business cycle.
It's been a shift, all right.
Cycles died, et cetera. I'm just entertaining. What if this time is different? What if people feel more bullish?
What did the JetBlue CEO say yesterday? In terms of the antitrust environment, it can't get any worse.
Can't get any worse. That was a big takeaway from yesterday. Veronica, it's good to see you.
Yeah, good
Appreciate
to
your
be
time. Thank you. Veronica Clark of Citi saying that Chairman Powell could be dovish relative to expectations.
I'm not bullish. I'm just making the
back to that
argument.
again.
Well, I just think it's important to understand that right now there is a reason why people are so overweight in a certain thesis. It's not just simply tulips, right? There is the actual returns, there have been the actual profitability, and there is the promise of all of these things. Whether they get delivered, that remains to be seen. Whether we're misreading the data, that remains to be seen. Whether those trends historically are really powerful and reasserted themselves, that also is a very real possibility. I am just raising the other side.
Or it's just as simple, and I know you make this point all the time, that everywhere else in the world is just really on the back foot.
True.
America's the only place to be.
Bottle that, though. Terrifying stuff. Coming up next on the program, Lisa Shallard of Morgan Stanley, Bloomberg's Tyler Kendall, Anna Nikolaevsky of Axel Capital Management, and former St. Louis Fed President Jim Bullard in the second hour of Bloomberg Surveillance. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
One of the institutions you've been very philanthropic with is your alma mater, Harvard. But recently, you've been very public about your criticism of the way Harvard handled the events of October 7th and their aftermath. Could you talk about that now?
The first reaction of a group of 34 Harvard student clubs on the morning after October 7th was to put out a statement saying that Israel was 100% responsible for the acts of Hamas. And my view on that was, that's ridiculous. You can come out and say, look, I'm very unhappy about Israel's treatment of Palestinians in the West Bank, or you can say, we can talk about the Gaza Strip, but you can't support terrorists, and particularly terrorists that rape and pillage and murder and burn and take hostages. Well, I got actually a text from a CEO in my industry. He's like, Bill, you know the people at Harvard. I'd like to know who the students are behind these clubs, so I make sure I don't inadvertently hire them. And so I tweeted out that sort of made that point, and caused a bit of a firestorm, and I got a lot of pushback. Oh, why are you picking on students? And I said, look, you can't hide behind a corporate entity if you're going to support terrorism.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
People are setting up for the potential for the Fed to sound hawkish.
We're not as optimistic as the market has been about further rate cuts here.
I think you may see a Powell that's a little bit more dovish than what the market's expecting.
In order to manage the soft landing, we need to keep easing monetary policy.
The labor market is stable if you look at the main features of it. That's going to put pressure on the Fed as it seeks this 2% target.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Equity futures on the S&P 500 up by 1/4%. Something in common with the people around the table complaining about their children as we start this hour. Equities right now on the Nasdaq 100 up by 1/4%. On the small caps, we're up by 0.5. Over the last few days, the last month in fact, every single trading day of December, we have traded with negative breadth. Will that change a little bit later on this afternoon? That's the equity picture. This afternoon, the main event, you know it, 2 p.m. Eastern Time. Chairman Powell makes a Federal Reserve interest rate decision, the final one of 2024, widely expected to be another interest rate cut. That's another 25, plus the previous 25 and the 50 back in September, 100 basis points of easing over the past 3 meetings.
Key question for me, a couple of them. First of all, how much does Jay Powell confirm what the market is expecting, which is a higher neutral rate for 2025? And does he push back against this idea that they would welcome they would not welcome any material weakening in the labor market? Does he have that same level of conviction that basically this is a fragile labor market that needs to be sustained for a longer period of time? Or is there a bit more confidence in the heat underlying this market?
We just talked to Verona Clark, and she's talking about the fact that we just don't know the makeup of these policies next year and how difficult that is going to be for the chairman, because he's going to be asked, what does immigration mean? What does tariffs mean? What does tax cuts mean? You already had a first iteration of Trump. You were deemed chairman during that iteration. So what can you tell us about what these policies might mean for the Fed decision-making? It's going to be a very tough place today.
Expectations matter. I like what Veronica did just moments ago. When we talk about things being dovish or hawkish, you have to think about relative to what. So when we have the dot plot a little bit later, you compare that to September. Yes, we're expecting the dot, the median, to come down somewhat. But the bar to be hawkish compared to what we're priced for in 25, we're already looking for, what, 2 cuts? In 2025, that's down from where the Federal Reserve was back in September. Can they even meet the market in today's meeting? That's a bigger question.
And maybe that's the reason why this is a Fed Chair Powell that always seems dovish, because he's not moving as quickly as the market is basically inferring that strength out into the future. So even if they do revise significantly their dot plot, how far does he have to go to actually edify what the market is saying? And if he does, how much does that spook the market and say, wait a second, maybe he's getting out over our skis?
That's the Lisa we know and love. Bearish once again. 3-part act a little bit later.
decision at 2 p.m. together with a summary of economic projections. You'll get the dot plot within there and all the forecasts. 30 minutes later, a news conference with Chairman Powell. Equity futures right now on the S&P 500 up by 0.25%. In the bond market, yields just about unchanged, up by almost a basis point. The 10-year through 440 this morning. And in foreign exchange, some stability in FX for the euro, just about 105 at 104.95. Coming up this hour, we'll catch up with Lisa Shallard of Morgan Stanley on why markets are losing the plot. Bloomberg's Tyler Kendall as the House releases a stopgap funding bill, and the former St. Louis Fed President Jim Bullard counting down to the final Fed decision of 2024. We begin this hour with stocks pushing higher, going into the Fed decision with a quarter-point cut expected. The path forward is much, much murkier. Lisa Shallard of Morgan Stanley saying the implication of 2025 is that it will be tough for more cuts and disinflationary growth acceleration to both play out. We believe that growth will likely disappoint first, and further Fed action will be constrained. Lisa joins us now for more. Lisa, it's good to see you.
It's great to see you, Jonathan.
Let's build on that. Why will further Fed action be constrained in 2025?
So our perspective is we're already seeing inflationary pressures build. Again, I know that the traditional economists among us like to, take apart the data to fit the narrative that they've assumed. But when we just look at the top line data, we've had 4 months of accelerating core CPI data, flat out. And that's with the advantage and the tailwind of a 20% drop in oil prices year over year. If, in fact, oil prices have bottomed out because global growth has bottomed out, and that if we assume that some of the cuts that have been put into the global system start to take effect in 2026, if we get a little bit of stimulus out of China, if oil starts coming back and we look at some of the dynamics in inflation, we could have very sticky inflation last year. I mean, this last print, you had goods prices up and food and grocery prices led the way.
Bigger, not hotter, was a theme for 2024.
Yes.